Okay, good morning, everyone. So today I'll explain about different option strategies. So most of us know about naked calls, naked puts, but many of the members are not clear about what are debit spreads, what are credit spreads, what do you mean by iron condor, butterfly, when to use which one, right? So today we'll discuss and how to use our indicators, which strategy is the best one, like that we can discuss. So let us take some real-time examples so you can understand which one is the best one. So there are some stocks like UNH is bullish now. So here on the chart you can see different things. One is, right, this is called as a channel, right? Either a channel or a band basically represent whether the stock is going uptrend or downtrend. And generally, if it is right, if the channel is pointing towards the upside, that means the stock is very bullish. If you see something like, let us go to SPX. Here you see it is in the downtrend. The channel is in the downtrend. That means it is in a bearish trend in that particular time frame, whatever you are checking. Right? So what do you think about PDD? Do you think PDD is bullish or bearish? By looking at the channel direction. So do you think channel is point, right? Channel means this top line, this is the bottom line. So do you think PDD is in uptrend or downtrend? So you have to see, is it going upside or is these two lines going towards the downside? Right, it is upside, right? Because this is right, it started and it is going towards the upside. So PDD is bullish. Yeah, then tell me for KWeb. So yeah, I'm asking this question so you can learn while KWeb is also very bullish because you can see that it is going in the right, the channel is in the uptrend. So whenever something is in the uptrend, you can make money in different ways, right? One is you can buy the stocks, right? For example, let us say PDD. Now you got a buy signal, right? Price went all the way to nearly $120 and it did a pullback. Overall, you can see that it is in a uptrend direction. And your trend is completely bullish, momentum is bullish, strength is good. And if you want, even you can check what is the score, right? We can go and you can just, instead of NVIDIA, I can change it to PDD. Say, okay. So PDD is showing score of 31. That means it is very bullish in all different time frames, 1 minute, 5 minute, 15 minute, 1 hour, like that. So when you identify one of the stocks is very bullish, score is 31, trend is good, channel is an uptrend, then you can wait for a buy signal and you can buy the stock. Right? If you are a busy professional, you don't have time to manage your option trades or something. You also see that there are a lot of buyers here waiting, right? The trend is bullish. Your table is showing that it is bullish in all time frames. Momentum is bullish, strength is good, the score is good, right? And then you see there are a lot of buyers. So you got a perfect confidence. If I came all the way to the bottom, it started bouncing up. You see a lot of buyers here. You got a buy signal. So this is a perfect opportunity to buy the stock, right? You can buy the stock. And what do you think it can go minimum, right? There is a high possibility it may break this, but by looking at this chart, what do you think the possible target? for this PDD stock on Monday morning, tomorrow morning. Right, minimum is 120 because there are some sellers here. So if you see some red, that means there are some sell orders at this point. So minimum we are expecting is $120. But if there are more buyers, they can break this and they can go much further high. Right? They can go all the way to 122 or $123 also is possible. Because already you can see, right, there are 734,000 buyers here. You got a buy signal, it went all the way up, then did a small pullback and again started because price will never go in one direction, right? Always it will go up, come down, created a higher high, higher low, higher high, higher low, higher high, higher low, and again it is going up. So there is a high possibility for PDD to go till 120 to 123 or minimum is $120. So if you are a buyer of a stock, you are investing $119, right? Let us say you want to buy 10 stocks. That means you are investing 119 into 10, 1190, and then maybe after 1 hour or something, it may go to 120. That means you are making a profit of $10. So your investment is huge. Your return of investment is will be less. But the advantage is, even though it may be choppy for entire day, even if it goes on Tuesday, Wednesday, whatever it happens, you don't need to worry. Whenever it reaches that 120 or 123, you can take the profits. Right? If you're a busy professional, you can just buy a stock whichever you feel like is looking bullish. The time frames are showing good, right? The trend is bullish, momentum is good. You see buy orders, so you can pick such type of stocks. You buy the stock, and at the end of the day, you can make some $100, $150, like that. That is the simple strategy. If you are a low risk trader or somebody who is very busy, not able to manage their option positions, this is the strategy you use. But your return of investment is very, very less, right? Because if you are spending nearly $1,200, if you are making $10 profit, it 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 may not make a lot of sense, right? So that's why you have something called as options, where you are not really buying the stock, you are only just buying a contract. If you are bullish, you can buy something called as a call contract, call options. If you are bearish about something, you can do put contracts. So if you are bullish about this PDD stock, right, on Monday morning, what we can do, you can buy something called as calls. So that is the basic types of option contracts, which are naked calls and naked puts. So let me show you with Thinkorswim some brokerage so you understand what are these call and so for example, you can put PDD. So you have expiration, right? For stocks, there is no expiration. If you buy the stock, you can hold it as much as you want. There is nothing like expiry date. But for option contracts, there is a limit, right? There is an expiry date. That means after that date, your contract is no longer valid. So, for example, right, generally for stocks, you have the weekly expiry, right? Like 22nd, 29th, 5th, right? Whichever you see here in yellow color, they are weekly expiries. And then you have monthly expiries. So if you don't want, so weekly expiries comes with high risk and high reward. Monthly expiries comes with low risk and low reward. So if you are a swing trader, you don't want to just take profits quickly, you want to hold them for longer time, you can go with monthly expiries, right? 19th September, 17th October, 21st November, these are monthly expiries. So you have 33 days more for the monthly expiry. You have 61 days more for monthly expiry, 96 days more for monthly expiry. Whereas 5 days for the weekly expiry, 12 days for the weekly expiry. So these are the weekly expiry. So for example, because you saw that PDD is looking bullish, one thing we can do is the basic thing is buying the stocks. The second best thing you can do is we can always go and buy naked calls, right? For example, here you see that there's a lot of volume here for 120 call. There is a lot of open interest. That means a lot of people are interested for this particular contract, right? Either we can buy a 119 call or we can buy a 120 call. That means if price starts going up, let us say you bought 120 call on Monday morning. If the price starts going up, so you are spending nearly $1.6 for each stock, right? That means it is between the bid and ask. Bid is 1.4, ask is 1.8. You may buy something around 1.6. That means for one stock, you are telling that I am ready to pay 1.6 so that even if it goes to 125 or 130, whatever happens to PDD before this date, you can buy the stock at $120. That's what you are doing by buying the call contract. So, for example, you bought at 1.6, but you cannot just do for one stock. You have to do for minimum one option contract means 100 stocks. So that means your investment is $160. So instead of investing $1,200 on buying 10 stocks, now your investment is $160, right? I hope it makes sense, right? If you know that the stock is bullish, you, right? Here you know the stock is very bullish. PDD is bullish. It can minimum go to 120. If it breaks this, it can go all the way to 123. You saw multiple reasons, right? You got a multiple confidence that okay, it came to the bottom, right? It went all the way up, now came to the bottom. There are a lot of buyers here. Here it is bullish, here it is bullish, here the score is 31. You have so many reasons to believe that the stock will go up. So now you have different options you can do. So, right, PDD, bullish bias for Monday. So now you can do different things. One is your option one, you want to make some money with stocks. You can buy, let us say, 10 stocks or 100 stocks. So your investment is 11,900. So if target is you are expecting it to go to $123. So your gain is, let us say, $122 minimum. Yeah, it seems like it will go to 122 minimum. So your gain, approximate gain is, so you invested around 12,000, you are getting 300. So approximately it is 0.25% return of investment. So your risk is low because there is no expiry date or anything, right? Whether it happens on Monday or Tuesday, Wednesday, or even next week, if it goes up, you will make profit. The second option is you can buy one option contract of 120 call. So 120 call for 22nd August. So your investment is $160. You are just investing 160. So which is nearly very less than the $12,000, right? So if the stock goes to 122 before 22nd August, it can become nearly $300, 300 to $320. So that means your gain is just with one contract, right? You may buy let us say 5 option contracts or 10 option contracts. So your gain is nearly 100%. But if that doesn't happen by next Friday, you can lose your entire whatever amount you paid. So that is with the naked call. The advantage is you can, with a low investment, instead of investing 11,900, you are only investing $1,600 because every contract cost approximately $160 for a 120 call for 822 expiry date. There is very high potential by looking at the order blocks, by looking at all these things. It seems like it can break this resistance, go all the way to the top of the channel. Then it will be, if it goes to 120 to 123 by this Friday or by Monday or Tuesday, if it happens on Monday itself, you can make 150 to 200% on your investment. If it happens on Tuesday, maybe 120%. If it happens by Thursday or Friday, you may make 100% of your investment. But if it happens on, right, it stays, let us say it stays, it goes down or it stays choppy for some reason, suddenly Trump announces something, more tariffs on China or something. Then because he is one of the China stocks, if it goes down like that, you have a high risk and high return if you do a naked call. So then you have a high risk. So that's what in options or in trading, generally when your risk is low, your return will be low. When your risk is high, your returns will be high. So now you have option one, option two. Then there is something called as option three. So this is called as, one is buying stocks. This is buying naked calls. The next option is buying debit spread. So in debit spreads, what you do is you have a small account. You want to reduce, even you don't want to invest this much. Then what you can do is, let us say, you think like minimum it will go to 120. So you can buy a 118 call and you can sell a 120 call. Right. So if you go here, you can see that 118 or 19, right? Around 118 call is $270. 120 call, if you sell it, you will get around $160. So you are buying 118, you are selling 120. So your investment will be much more less. And if the stock stays above 118 and below 120, you will make nice profits. Right? Or you feel like it may go break this, it may go until around 122. So you can buy 120 call, sell 122 call. So you are still a buyer. But only thing what you are doing is you think because price will never keep going up, right? Very, very few scenarios it may be very, very bullish and it may go much further high. But generally it will go up, again come down, again go up, again come down like that. So you feel like it will go up, but maximum it will go till 122. Then that is where to reduce your investment, you buy one or let us say 118 call and sell 122 call. So 118 call is approximately $270 and this is $110. So around your investment is still same, but your risk is less. So buying a buying and selling a call. So you are still Still a buyer overall because still you are paying, but your risk gets reduced. Here, for simplicity, let us take 120 call. Right, you are buying 118 call, 120 call. 118 is 260. Okay, it is around $110. So as long as it stays above 118, you will make profits in this scenario, right? Because here you see there are a lot of buyers. So the PDD to go below 118 is very, very less. And here you have some sellers. So instead of taking risk, what you are doing is you are buying a 118 call, you are selling a 120 call. So instead of $160, now your investment is only $110. So your risk is getting reduced, your investment is getting reduced. If it goes to 120, you will make nearly $2,000 on your contract. If it goes above also, you will only make 2000 because you have a cap now, right? This is like your max. If it goes above 121, 122, 123, you won't get that advantage, right? If you are just buying a naked call, if it goes higher and higher, you will make bigger profits. But when you are doing a spread, you are buying and you are also selling. So if it stays between 118 and 120, you will make nice profits. But if it goes above 120, 120 also, your profits are capped at a certain level. But your risk is also getting reduced because if it goes down, if it stays in between also, you'll make profits. Here, you are buying 120 call. If it stays at 118 or 119, you're right, your investment is at risk. But here, because you are also selling, you are a seller, you are also a buyer. Overall, you are paying, but your risk is less here. So let us say it goes to 2000. So your gain is approximately $900, around 80%. So this is like a medium risk. So if you are a medium risk trader, you don't want to take lot of risk, then you can do this. Right? For example, let us take some SPX example. Right? For example, here, right on Friday initially it was very bearish. It came all the way down. And then there were a lot of buyers here. And you see there are a lot of sellers here. So one thing is you can directly buy SPX calls here. But you see overall trend is looking little bearish. So you want to reduce the risk, you buy a call, buy 64.40 call, you sell 64.60 call. There are sellers here, sellers here. So generally it will go up close to the channel top and again it will start dropping. So this is how if you just to buy a call, if it is very bullish, right? If the channel is in a bullish trend, we can buy naked calls. If the channel is in a bearish trend, but you see that there are a lot of buy orders here. Instead of that means there might be a pullback, but it will not keep going up. It may go a little bit up and then start dropping. In this type of scenario, debit spreads are better compared to buying a naked call because overall trend is looking bearish. But there was a huge drop. There are a lot of big buyers are here. So there is a possibility for price to go up. It came all the way to the bottom of the channel. Now it is going up. So now you can do debit spread. So your risk is right. You are not spending $20 or something as a premium to buy a call. You are buying 20, you are again selling it and again making some $10 by selling a call contract. So you are buying 64.40, you are selling 64.60. So now instead of spending 2000 as your investment is only $1,000. So if it goes up and then you see a sell signal, you take the profits. Like that, to reduce your investment for a low risk trade, you can use the debit spreads. Right? I hope you are getting it. If PDD is looking very bullish, you see a buy signal. Right? It is completely bullish. All you have proper confidence. Right? It is a bullish stock. Channel is in the uptrend. Score is 31. T5 is at the bottom. Momentum is very good. Strength is good. Then let us say you don't even have this resistance. Then you can confidently go and buy the calls, naked calls. Then you will make huge profits. But because you have a resistance here, right? We are still not very confident whether it will break this or it may touch this and again come back. So now, instead of buying a naked call, if you do a debit spread, your risk is less, right? So you are buying it. So if it may minimum go till here. So you are buying a 118 call, selling a 120 call. So as long as it stays above 118, so if it goes more also, you will still make profits. Only thing is your profit is limited, right? Whatever profit it goes till here, that profit you will make. If it goes above also, because you have 118 call, you sold a 120 call, still you will be profitable. So if there is no resistance here, then you can confidently just get the naked calls. Because score is 31, all the confidence is perfect. You can go ahead and do the just buy the calls. You don't need to do a debit spread. I hope everyone is clear. So instead of just becoming a buyer, here you are just a buyer, right? You are just buying a contract because you think it is bullish. You are just a buyer and you are not selling anything. So your investment is high. If the stock goes high, you will make huge profits. You have high risk and high reward. Whereas when you do debit spreads, you have medium risk, medium reward. So then there is one more thing you can do, right? So this is the normal strategy which everyone uses, but only risk here is if you see some stock and if it doesn't move or if it drops, then you can lose your 100% of investment. Whereas if it is a debit spread, if it stays choppy also because your 120 call you sold, you are a seller, the theta decay, IV, all those things will be an advantage to you. So your risk is minimal when you do a debit spread. Then there is one more thing you can do, which is called as a credit spread. So here what I can do, I can sell 118 put and buy 115 put and collect premiums. So in these two places, you are mainly a buyer. Here you are completely a buyer. Here you are 60% buyer, 40% seller because you are buying a lower strike call, selling a higher strike call. You are receiving some premium, but overall net you are paying something. Instead of 1600, you are paying 1100. So here what you are doing, you know that there are a lot of buyers here around this price. So the chances for PDD to drop is very, very minimal, right? It may go up or it may stay choppy. It may stay sideways, but the chances are very, unless there is any major bad news, the chances are very less for PDD to go below 118. So what you can do is you can go towards this side. You can become a seller. You are selling a 118 put and you are buying a 115 put as a right as a collateral or as a hedge. That means you are collecting around $170 and you are paying around $80. So sell 118 and buy 150. So selling a higher strike put and buying lower strike put. So here, so you are selling. So because you are confident that it will stay above 118. So as long as PDD stays above 118 before August 22nd, your risk is minimal. But suddenly, if there is any bad news, you don't want to just sell a naked put, right? If you sell a naked put and you suddenly, if there is a bad news, you have to right, you have to buy those stocks at $118. So that's why here you are selling, and as a protection, you are also buying a 115 put. In this case, you are collecting nearly $100 credit. So here you are not paying. You are like a seller. You are like an insurance company, right? You are selling a insurance policy to the person, telling that okay, if a PDD goes below 118, also I'll buy you at 118. Like that, you are telling him because you know that because you have a tool which is telling you it is very bullish. You are confident that this PDD will stay above 118. But that person doesn't know that this is bullish. He thinks that it may go down. So he is buying a put option, right? Put option means put contract as an insurance policy. So in this case, so in both these cases, stock should definitely go up. Here, if it goes up, you will make huge profits. Here it goes up, you have a cap. In this scenario, when you do a credit spread, whether stock stays same, you will make profit. Stock goes up to 119, you will make profit. Stock goes to 120, you will make profit. 121, you will make profit. Even if it goes little bit down, 117.5, you will still make profit because you are selling 118 put and you are collecting $100 credit. That means until 117, you have a you have a cushion. Even if it goes to 117 also, you are at a break even. But if it goes below 117, because you know that it is at the bottom of channel, generally bottom of channel will act as a strong support. When it is a bullish stock, here itself it will go up, but even if it comes little bit down also, it will go up. So now your risk is minimal. You are doing a 170, right? Up to 117, you have a cushion. If it go right, if it stays choppy also, you'll make profit because you don't need to, you are a seller. So if stock doesn't go up, if it just stays in the sideways market, you will make profit. If it goes up, you have chance of making profit. That is the advantage when you sell a higher strike put and buy a lower strike put whenever something is bullish. Here you have high risk, high reward. Here you have medium risk, medium reward. Here you have low risk and low reward. That means 90%. Here you can make profit 90% of the time. Here you can make profit 80% of the time. Here you can make profits 70% of the time. So it is so based on your risk profile. If you think like you don't want to take risk, you are a low risk trader, you can go with this option. Right? Again, I'm just giving PDD example, but you can use it for any stock, SPX, or right. You don't want any assignment risk, then you can do with SPX or XSP like that. So this is called as credit spreads, where you are selling a, if it is a bullish stock, you sell a higher strike put, buy a lower strike put, and then you collect the credit. As long as stock stays around this region, you will make profits. So that is so when it is completely looking bullish, you can do like that, right? Let us take some other example. So if Amazon comes to around 230 region, right, or Amazon comes to around this point, you have a lot of buyers here. So you can go ahead and do a bull put spread. Then you can make some nice profits on that bull put. So bull put, whenever you are at the bottom of the channel, you can go a little bit below, you can do the bull puts, right? For example, SPX, let us say, right, on Friday morning, we saw that there are a lot of buyers here. We got 64.40, 64.45 bull puts. That means if price stays above that region, all that premium is yours, right? Or you have a lot of sellers here. At the top of the channel, you can go and do the bear call spread above this. That means you are selling the calls. If you are at the bottom of the channel, you see a buy signal, you do bull puts below that region. That means if price stays above that price, all that money collected is 100% yours. So we know that there is a resistance here. So we did bear calls, right? Around this region, we did 64, 65, 64, 70, or 64, 60, 64, 55. Then all that money is yours. If price, so when you are bullish, we will do bull puts. That means you sell a higher strike, you buy a lower strike. You are bearish, you got a sell signal. You have a lot of sell orders here. You have a strong resistance here. Overall, this one is bearish, right? If you go and right? So if you are at a resistance, score is minus 31 or something, you can confidently get the puts. You can buy the puts, SPX puts, or you can do the debit spreads like that. But if your score is somewhere in between, but you see that it is at the top of the channel, you have a resistance, your T5 is at the top, your trend is little bit bearish, you can do bear call spreads. Then if price stays below that zone, by end of the day, you'll make profits, right? You got a buy signal at the bottom. You have a strong support here. You have a lot of buyers here. You do bull put below this region. Then you make profits. So when you are when the trend is completely right, if it is plus 31 or minus 31, you can confidently go ahead and do the naked calls or naked puts. Right? Let us say when you have a buy signal, your score is 31, you can do confidently go and do naked calls. Or if you want to take little risk, you can do debit spreads. But your score is somewhere in between. Then if you get a buy signal at the bottom, you do the bull puts. Or you get a sell signal at the top, you do bear calls. Then as long as price stays below this, you will make profits. As long as price stays above this, you will make profits. So that is called as a credit spread, where you are mainly a seller, right? If you are doing a bull put spread, that means you are telling that if SPX goes below this region, I will take care of it. Because you know that there are a lot of buyers here. There is a strong support here. You are at the bottom of the channel here. If I came all the way to the bottom, price will go up. In the same way, you see a strong resistance. You are at the top of this T5. You see there are a lot of sellers here, sellers here. There is a high possibility price will drop. Then you can do bear call spreads. So when you do bear call, you sell a lower strike and buy a higher strike. When you do bull puts, you sell a higher strike, you buy a lower strike put, right? As a protection. So again, I repeat, when to use which strategy? If if Netflix is 31 and you get a buy signal at the bottom, you can directly do naked calls or you can do debit spreads. If the score is 31, but it is somewhere here, then instead of doing buying a put or something, you can do credit spreads, right? If you are going against the trend, because your risk is low with credit spreads, you will do credit spreads. But if the trend is bullish, you are at the bottom, you got a buy signal, your T5 is also at the bottom, then you can confidently do naked call. You can be a buyer. But if you are going against, you can be more of a seller. because as a seller you have more chances to make money, because even if it goes choppy you'll make money. If it goes little bit down also you'll make money. If it goes up you'll make money. So when as a seller you have more chances, more probability for success. So when you are going little against the trend, you be a seller. When you are going along with the trend, you be a buyer. So if PDD, if the stock is bullish, if you have full confidence that it will go up, you be a buyer. You either buy the calls, you buy the naked calls, or you can do the debit spreads. But let us say for Amazon, the channel is at the bottom. My channel is pointing towards the bottom. So that means the trend is little bearish. But now you see there is a strong support here, right? Price came all the way to the bottom and you got a buy signal. You see that this will act as a strong support. Now instead of buying calls, naked calls or a debit spread, you can go a little bit below and you can do trade spreads. So if your trend, you are going along with the trend. If the trend is completely bullish, score is 31, you can confidently go with these two options, right? Either option one or option two, sorry, option two or option three, because you have high chance of success here because the trend is completely bullish. You can buy naked calls, you can make nice profits, or you want to take little less risk. So if you see that here or SPX, let us say, you know that it will drop from here, but this will be the support. So you buy this put, you sell this put. So your investment is getting reduced. As long as it drops, then you will make nice profit. So like that, if you are going along, if everything is aligning, if the trend, the T5, everything is aligning, you can directly confidently do buying these two. If the trend is not aligning, but you see that there is a pullback, there is a possibility of a pullback. Okay, SPX dropped all the way, but I see that there are buyers here. It came to the bottom of the channel. There is a strong support here. If I came to the bottom here, then you can do a bull put spread. Again, now it went all the way to the top. Then you have a strong resistance. Now it is, if your score is minus 31, T5 is at the top, your table is completely red. You can confidently do you can buy the puts, SPX puts and make nice profits. Or you can do the debit, right? You can buy a put, sell a put, debit, you can do debit spreads and make profits. So when you are going against, you do credit spreads. When you are doing, when you are going along with the trend, you can do the naked puts or debit spreads, right? So that is about, so I explained about what are different, right? One is buying stocks, one is buying naked calls, one is doing debit spreads, the next one is doing credit spreads. Then there is something called as an iron condor. So iron condor is nothing but combination of both bull put and bear call. So for example, right, let us say, so what is bull put? Bull put, when you are bullish, so bull put means when you are bullish about something, you are selling a higher strike put and buying lower strike put. Then what is bear call? So these both are credit spreads. So when you are bearish about a stock, sell a lower strike call and buy a higher strike call. So, for example, right, let us again take the example of PTD. So instead of making money in one way, you can make money in two different ways with a iron condor. So you are confident that PDD will stay above 118, and you are confident that it may go until 122 and again it will drop because that is like a top of the channel. So instead of just making money in one way, right, or let us take example of SPX. Here you know that overall trend is dropping, but it may go till here and again drop. So if you are a busy professional, what you can do when price comes here, you can do a bull put, you can also do a bear call. That means you are telling that okay, SPX will stay above this 64.40, but it will stay below this 64.60. So you are doing a bull put here. That means if price stays above this zone, you can keep all that money. If price stays below this zone, you can keep all the money. So in the morning time, you open both. Even though you are busy in your office, by end of the day, if it stays above this and below this, you make money on this side, you make money on this side. Right? That is called as an iron condor. You are not just doing a bull put. You are not just doing a bear call. You are doing both a bull put and bear. That means you collect some $150 from here. You collect $150 from here. Then you are making money on this side. You make money on this side. So you are collecting. You are making nearly $300. So right, instead of just doing one direction trade, you see a support here. You see a resistance here. You see buyers here. You see sellers here. So you know that the price will stay between these two, right? Here you have a lot of sellers, here you have a lot of buyers. You are trying to do a bull put. That means you are selling a 64.45, 64.40. You are selling a 64.60, 64.65. If by end of the day, right, whatever strike price you are taking, right, if we are doing the same day expiry, that means, right, for ETFs like SPX, SPY, QQQ, all these things, you can do same day expiry. For stocks, you have to do weekly or monthly expiry. So with SPX, when you see this type of opportunity, you are not just depending on, right, for example, if you do this and do this, you are making money on both the sides if it stays somewhere in between. Or let us say it dropped, right? Let us say you did a bull put, it dropped. Minimum you got some money here, you also got some money here. So your risk is same, right? If you are just buying a bull put and if price drops, you are already taking a risk. But if you are buying a bull put here and also selling a bear call here, if it drops, you already collected premiums here. You collected premiums here. That means this is minimum helping you to recover some of your loss. Right? You are not just doing one side, you are doing two sides. So even if one of the if it stays in between, that is the best thing. You are keeping all this premium. But you bought a bull put and suddenly it started dropping. So now you are taking more loss. But if you are doing a bull put and bear call, and if it drops, because you did a bear call, you collected some $150 here. You collected bull put, you collected $150 here. So now instead of you are risking $350, your risk is only $150 if it goes against you. So that is called as an iron condor, where you are doing a bull put at a support, you are doing a bear call at the resistance. So you are taking two trades so that if it stays in between, you make 100%, 100% on both the directions, right? For example, tomorrow morning, let us say price comes here, we can, right? Or price comes little bit down here, right? Overall, SPX is in a bearish trend. So let us say it may break this support and comes here and starts going up. Then you can do a bull put here, 64.30, 64.35. And then we can do some 64.50, 55. So you make money on the side and also on the top side, like that. So if you are a completely trader who can put full time in trading, then whenever price comes to this, you see a buy signal, you do bull puts. Whenever price goes here, you see a sell signal, you do bear calls. But if you are someone who cannot wait, you want to just take a trade and you want to go to your job, then you can do the combination and you can, because now you are covered. Minimum, even if it drops also, you did a bear call, you did a bull put, your risk is less. So in that way, if it stays in between these two zones, then you have 100% of profits from here, 100% of profits from here. If it goes completely up or completely it breaks this level, completely goes down, you have your risk got reduced. You are not just going one direction, you are taking trade in both the directions. So minimum your risk is less. If you take only buy, if it goes down, you have more risk. If you take only sell, if it goes up, you have more risk. But you are doing a buy collecting premium, you are doing a sell collecting premium. So even if it goes, if it stays in between, that is the best scenario. But even if it goes in one way completely down or completely up, your risk got reduced. Now, instead of making $150 on a $500 risk, you are making $300 on a $500 risk. Like that, that is called as an iron condor. Whenever you see price at a bottom, right? If you are a complete full focus trader, whenever you see buy signal at the bottom, you do bull puts. Whenever you see sell signal close to the top of the channel, you do bear calls. But if you are someone who is completely busy, who cannot put a lot of time into trading, around 9 o'clock, you see where SPX is. Then based on that, you can do both the sides. That is called as an iron condor, where a combination of bull put and also a bear call. Right? For example, PDD. If you think like it will stay between 118 to 122 or 123, you do a bull put at the bottom. That means you are selling 118 put and buying 115 put. In the same way, you sell a 124 call and you buy some 126 call. That means if by end of this Friday, if PDD stays between that and between this, right, if it goes up and comes down, then you are making profit on the top, you are making profit on the bottom. If it stays between 118 and 124 by end of this Friday, or it goes up, and then if it stays somewhere in the range, because it is that is the top of the channel, right? It will not just keep going up. It will go up and again there will be a pullback. It may go up, pull back, go up, pull back, go up, pull back. So you will make profit on both the sides. So iron, if you are a full completely who can spend, then whenever you see a buy signal, you do bull put and it goes up after some time, 3 4 hours, you see a sell signal, you do bear call. But if you cannot focus, then you can even do even before itself. You see that okay here, let us say right, this resistance is little bit up. You do a bull put here. Wherever you see the resistance, you do the bear calls. In that way, you make money on both the sides. So you are not taking a high risk. You are taking a low risk, and you can make money on both the sides. So that is called as iron condor. So combination of both bull put and bear call. Bull put at support and bear call at resistance. So now your risk gets much reduced, right? Here you are just doing a one side. Here you are doing both the sides, right? Here you are doing like sell 118p and buy 115p and sell 124 call, buy 126 call. That means you have two different legs. One is the bull put, one is the bear call. So you are thinking that PDD will stay between 118 and 124. It will not go above 124. It will not go below 118. As a protection, you are also just buying a put and buying a call. Suddenly, if it goes so much up, you have a protection. So now you make collect premiums on both sides. So if stock stays between 118 and 124, that is the best thing for you. You make some 150 $200 from this side, 150 $200 from this side. Even if it's stays choppy, completely stays choppy the entire week, you will make money. If it goes up and stays below 124, you will make money. So you have lot of ways you can make money when it stays between those that range with a low risk, right? If you buy a 118 call or something and if it doesn't move, you will lose. If you do a debit spread, it doesn't move, you lose. But if you are doing a bull put at a support, you have a lot of buyers here. And let us say you have some resistance here, you have a lot of sellers here, right? So as I said, right, tomorrow morning, if we see E is dropping further, right? Let us see you see a buy signal here. Then you can do the same thing, right? Around 64, 40, 45 bull put, and you see sellers here. You do bear call spread here. So you are doing an iron condor, a combination of a bull put and bear call. Price stays in between. You keep money from this side, you keep money from this side. If price goes down, minimum you collected premiums from here. It is better than just doing a bull put spread. Now you did a bear call spread, so you collected some premiums here, some premiums here. So if price opens somewhere in between, or price is somewhere in between, then that is the best thing you do iron condor. If price is opening right tomorrow 9 a.m. price is somewhere here, you see a buy signal, then you can do bull puts. Or tomorrow you see price is somewhere here, you see a sell signal, you do bear calls. The price is somewhere in between, you do an iron condor. You do a bull put, you do a bear call. If it comes up and starts going up, or if it goes up and starts coming down, you make money in both the sides. So that is called as an iron condor, which is a combination of a bull put spread and a bear call spread. So we do bull puts at a support at a bottom of the channel. We do bear calls at the resistance at the top of the channel. We do bull puts when we think price will go up. We do bear calls when we think price will go down. So you are acting as a seller rather than buyer. If if you want to take low risk, you want to take advantage of theta decay and implied volatility decay, IV decay, then trade spreads will give you that advantage because you are a seller. As time is, if it stays choppy, it is not moving as anticipated, right? If you are buying something and it is just staying choppy, you will lose all your premiums. But if you are selling something, if it stays choppy, that will be an advantage to you. So that's why trade spreads always has a higher advantage, higher chance of making profit. Only thing is, yeah, if you are at a bottom, if you are at a support, you can do bull puts. If you are at a resistance, you are at the top of the channel, you can do bear calls. If you are somewhere in between, you can do iron condor. You go below the support, do the bull puts. You go above the resistance, you can do bear calls, right? Or you wait, right? If you can completely focus and you can spend time on trading, then you wait for price to come to this support and start reversing, right? For example, tomorrow morning it breaks this support and comes here because generally if something is bearish, right, what it will do is it will it will break yesterday's low of the day. So here this is the low of the day on Friday. Tomorrow it may break little more, come little more down, and then again it will bounce. So in case tomorrow SPX comes all the way to this, right, because already it went to this support on Friday. Tomorrow you may see little more drop and come all the way here, and then you see a buy signal, and then you see a reversal. Then you do bull puts here. When it goes little bit up, and then it starts, you see a sell signal, you do bear calls. So that is about an iron condor, right? I hope it is making sense, right? If you are completely bullish, we do naked calls. If you are completely bearish, you can do naked puts. If you are if you don't want to take risk, you can do debit calls, debit spreads with calls, or debit spreads with the puts. That means you are not just becoming a buyer, you are also trying to sell, right? Instead of just buying these puts, you also sell these puts. If you think price will drop, but price will bounce from here, you buy this put, sell this put. Or you think it will go up, but it will not go above this, you buy this call, sell this call. That is a debit spread. Credit spread is instead of you paying some premium, instead of you paying some money, you are collecting the money. You sell a higher strike put, you buy a lower strike put. You sell this put, you buy this put. Or you sell this call, you buy this call. When you are at a resistance, you do a bear call spread. When you are at support, you do a bull put spread. So that is called as an iron condor, a combination of both. So if price stays in between, you make money on both the directions. Right? Generally, when VIX is less, volatility is less, this is the best thing to do. When the trend strength is not in 30s, 40s like that, right? If the strength is very high, very bullish or very bearish, better you just go in one direction. But if the strength is low, if it is choppy, that means price will just go up, come little bit down, so it will stay in a small range. That is where you can make money on both the sides. But if the trend is very, very strong, suddenly there is a major event and there is a huge drop or huge bounce, right? On major events, don't go with iron condor because there can be a huge drop or there can be a huge bounce. But Friday is there is no major event. Or Monday, Tuesdays, generally there won't be major events. Right? On Wednesdays, Thursdays, there will be some job reports, CPI, PPI, FOMC, such type of reports. On those when you don't have any reports, you can make money on both directions. When you have a report, then it is better you either do only bull put or only bear call, or you can just be a buyer or seller based on the news. If the report is positive, CPI was positive, so there was a huge bounce on the day. PPI was negative, there was a huge drop on that day. So like that, based on the report, you can just stay on one side. But if it is a choppy day or a neutral day without any major events, we can just take a iron condor where you can make profits on this bullish side and also bearish side. Then the last one is called as a butterfly, right? Another strategy is a butterfly. In butterfly also you have two options. One is long fly, second is short fly. So what do you mean by long fly and short fly? So in butterfly, what you do is here you are going below the support doing a bull put. You are going above the support doing a bear call. Right? For example, tomorrow morning, let us say you see here, right? SPX is opening somewhere in middle, right? And you see that overall it is looking bearish. Then what you can do is you can sell the call and sell the put always, whatever, right? So here, if price is somewhere here, if you are collecting doing a bull put, your premiums will be very less. If you are collecting a bear call, your premiums will be very less. But your premiums will be very high at the current price. So instead of doing a bull put and bear call, when your SPX is somewhere in between, right? It is between the resistance, between the support. And you see that overall it is looking bearish. Then what we do is you sell the call and sell the put here, right? For example, 64.50. You sell 64.50 call, you sell 64.50 put, and you collect the premiums. And you buy this call and you sell this put. Sorry, right? You are selling this call and put at the current price. Whatever is the current price, if it is 64.49, you sell the call and put at 64.50, and then you buy a call and buy a put. You buy this call, you buy this put. You are selling the strike, and you are buying these two. So if it stays in between these two, you are collecting credit, you will make nice profits. So if price is somewhere at a support or resistance, you can do bull puts or bear calls. But SPX is opening somewhere in between. Instead of doing bull put and bear call or doing iron condor, your risk will be much more less because you collect a lot more credit here, right? You collect some nearly $220 or $210 by selling a call. You collect another $220 by selling a put. That means if price comes here and starts going up, overall you are collecting nearly 440 $450 for a $500 risk. That means if price stays choppy between these two ranges, you will you will make all that money. If price completely goes above or completely goes down, your risk is only $50. Your reward is much higher, right? With bull puts or bear calls, you take less credit and your risk is high, right? You may collect 100 $150 here, but if it goes against your direction, you have 350 risk. You do a bear call here, suddenly it starts going up, you collected 150, but if it goes up, if you are doing a 5 point spread, 64 60 64 65, suddenly it goes up, you have $350 risk. So your risk is less or your reward is less, your risk is high. But when you do a butterfly, you are selling a current strike call or current strike put. You are selling both current strike call, current strike put. Because you are at the current price, your premiums will be much more higher. You are collecting much higher premiums and you are going below and buying this call. You are going above and buying this put. So your overall risk will be minimal. So your if it stays choppy, you will make nearly $400 as a credit. If it goes against your direction, $50 is your risk. In that way, your risk to reward will be much more higher with a iron fly, and also your investment, right? Even though you have a small account, with a bull put or bear call, you need to have minimum $500 to do one contract. With a iron fly, all you need is $50 to $100 investment to do one contract because you are doing both the directions. You are selling a call, selling a put. Right? For example, we did MAT. So yeah, MAT, circle, different things. We made nice profits. So your risk will be minimal, your reward will be high. If SPX is bullish, right? Let us say SPX is bullish and it is somewhere in between. You buy a call, you buy a put at the current price, and you uh, sell a put, and you sell a call. So if you are bullish, if a stock is bullish, you buy the call, buy the put at the current price, and then you can sell the put and sell the call far away. Then if it goes up, you will make nice profits. If the SPX is bearish, you do something called short fly, which is selling a call, selling a put. And as a protection, you are buying a call, buying a put. If you are bullish about SPX and it is somewhere in between, you buy the call, buy the put at the current price, and you sell the call, sell the put to collect the premiums. So your risk will be less with a iron fly compared to an iron condor, right? So long fly, when ticker is bullish, buy, call, and put at current price, and sell, call, and put when ticker is bearish, So this is your, so one is directly buying the stocks, one is buying the naked calls, one is doing a debit spread, right? In all these cases, you are a buyer. Here, you are mainly a seller, but you are only taking trade in one direction. Suddenly, if it goes against, you have high risk with a low reward. Iron condor, you are taking trade in both the directions. You can make profit if it stays in between those both the zones. But if it breaks one of those zones, you may still have a loss. But here butterfly, if you are bullish and if it makes a big move, you make profit. If you are bearish and if it makes a big move on the downside, you will make nice profit. So your investment will be very minimal compared to any of these options. Your reward will be high here, right? Here your reward is less and risk is high. With the iron fly, your reward is high and risk is less. So again, right, for example, tomorrow SPX opens around this price. Then what I can do, I can do 64, I can sell 64.50 call, I sell 64.50 put. Then nearly I am collecting 220 dollars in both. Right here, if I do a bull put, I collect only 100 or $120. If I do a bear call, I collect only 100 or 120. So I'm collecting only 120 here, 120 here, 240. But here, if I sell a call and put, because overall SPX is bearish. If I sell a 64.50 call, 64.50 put, I'm collecting nearly 440, $450. And then if then we can buy a call here. I can buy a put here. So overall, your risk is only $50. If it goes in either direction, if it stays choppy, in all the ways you have more chance of making a profit. So if you take PDD example, if PDD is bullish, right, I can buy a 118 call, I can buy a 118 put, and then I can sell this put, I can buy this call. So if you are bullish, you buy the call, buy the put. You sell this put, you buy the call at the bottom. If you are bearish, you sell the call, sell the put at the current price. So if you go here, right, for example, SPX, you can go here and you can just say, if you are bearish, you can go and you can say butterfly. That means you are selling 20 contracts of 64.45. You are buying one put at the bottom, you are buying one put at the top. Overall, your debit is only your risk is 30 cents or $30, but your reward will be much more higher. In the same way, if you are bullish, so if I am bullish, I basically do a buy. Right? You are buying a 64.40 call, you are buying a 64.50 call, you are selling the current price, you are selling the calls. So your overall risk will become minimal if there is a big move on either side. If it goes completely down or if it goes completely up, you make profits. So whenever you have choppy days, right? If you are expecting that price will stay choppy, that means generally on Mondays, Fridays, generally price will stay choppy. That is where your iron condors are best. If there is a major event, you are expecting a big move, then iron flies are the best. Right? Whenever there is a big move, either upside or downside, your iron flies will make much more profits. Your iron condors are risky on those days. Whereas if you are expecting price to stay choppy, then you do a bull put, you do a bear call, and if price stays in between, you make money on this side, you make money on this side. But you are expecting a big drop or a big bounce, then the iron flies. If you are expecting a bounce, right, you got a positive report with CPI. Then you buy a call, you buy a put, and then if it makes a huge move on either upside or downside, you make profits. Or you can sell a call, sell a put, you collected high premiums. If it makes a big move on either side, you will make nice profits. So like that, if right, naked calls, debit spreads, when you are completely going along with the trend, naked, right? If your score is 31, you are at the bottom of T5, you are at a support, you have a big buy order block, your momentum is completely bullish, right? For PDD, doing naked call or a debit spread is best thing because it is completely bullish. Your score is 31, it is at the T5 bottom, that is the best option. And it came to the bottom, it is at a buy order block. So the strategy to choose is out of all these, you can you can go with option 2 or option 3. If you have some stock like, yet you have something like net, overall trend is bullish, it came to the bottom, but you have resistance, you have a lot of sellers here. Then instead of buying calls, you can do bull put spreads. Right? If you get a buy signal tomorrow morning, we can do bull put spread below this region and you can collect the premiums because you have a lot of resistance here, here, here like that. So if you see lot of resistance or you see lot of sell orders, then instead of doing naked calls or debit spreads, you can do bull puts, right? If you go, right, let us say you can do 200 and 195 bull puts like that. So, but yeah, basically based on the scenario, you can choose whichever strategy suits your risk profile, or if you are going along with the trend, then naked calls, debit spreads, they are the best. If you are going against the trend, right here, because SPX is overall in a downtrend, right? Channel is in a downtrend, but it came to the bottom, you see buyers. So doing naked calls or debit spreads is little risky here because when trend is bearish, you don't want to take a high risk. But you see there is a potential for it to go up, right? There can be a pullback. So this is the time you do trade spread, you do bull put spreads. When you are here, you know overall trend is bearish. Channel is pointing towards the downside. There are a lot of sellers here. You got a sell signal. You can confidently either buy the puts, you can do debit spreads, or you can do iron fly. You can sell your call, sell your put, and you can collect high premiums. And if there is a nice drop, all that premium is yours. So yeah, basically based on the trend, based on where the price is, we have to select. If you are somewhere at the bottom, bull puts; somewhere at the top, bear calls. If you are somewhere in the middle, based on the trend, you can do the short iron fly or long iron fly. If you are somewhere in middle of the support and resistance, if it is completely very bullish, you see big buy order block, there is some positive news. UNH, we saw that there was a positive news. So such type of scenarios, you can basically do buy calls, naked calls, right? For example, tomorrow, if it comes all the way to this $298 zone, right? If UNH comes to this 298, there are a lot of buyers waiting here to buy it. You can confidently do naked calls or debit spreads, right? Or right, you buy 298 call, you sell 310 call. It can come here, touch this, and again go all the way to 310. So like that, based on the strategy, you can decide whichever you want. Yeah, but so that you understand which strategy is better or which one based on where the price is. If it is exactly at a support or exactly at a resistance, then you can use naked call strategy, debit call, debit put strategy. If if you want to take low risk, low reward, you can do right again based on where the price is. Tomorrow morning here, right? For example, here you are a busy professional. You don't want to miss this, but you never know when it will come touch this, right? You can go and do a bull put spread on UNH. You can sell 300 put and buy some 295 put. You can collect the premium because it may come here and then again go up. The chances of UNH to break this 300 is very, very minimal. Yeah. So if you are a seller of a call, you don't need to have shares. Right? For iron converts also, you don't need huge investment, right? All you are doing is, uh, if you have even $1,000, you can do an iron convert with SPX. You have, whenever you take a spread, you have a 5 point spread. We generally do 64.40, 64.45. That means $5 spread, you are collecting some premium. Here you are collecting some premium. So all you need is maximum $1,000 investment to take trade on both the sides. So if it stays in between both, then you make money on both the directions. If it goes completely above it, completely below it, then you have minimum your risk is less because you already collected nearly $300. Even if it goes one way above your resistance or one way below your support, your risk is only 200. So that's why iron condors use when there are no major events, right? Mondays, Fridays, Tuesday, generally they are the best days. When there are no major events, iron condors are the best. When there are major events, there can be a huge move either on the upside or downside. We do the iron flies. So if you are expecting a big move on the upside or big move on the downside, your iron flies have more advantage, or you have a high reward with a low risk because you are collecting premiums at the current strike price. So if you are expecting a downtrend with SPX, you sell the put, sell the call here. So if it drops, then you make more profits. Yeah, PG, please let me know if you have any questions.
Uh, Hey, Krishna Garu. I just want to know how much collateral is needed for each of these option strategies that you mentioned.
Right, generally, right, if you're taking a 5 point spread, then $500 is the maximum collateral you need. So, for example, if you're taking PDD 118 and 120 call, so if you have $200, that is enough for one contract. If you are buying 10 contracts, you need $2,000. So, whatever, right, if you are buying 118, 120, that means there is a 2 point difference. So, all you need is $200. You are collecting some premium. So, yeah, your risk is maximum less than $100 for every option contract you're buying.
Okay, so this is I would say better than the naked, right? Because you can do multiple contracts with lesser collateral.
Yeah, that is right. Yeah, with naked calls you need high investment, but
Yeah.
here you need low investment because you are a buyer, you are also a seller, so your investment is getting reduced, and your chances of success are also high. Even if it stays choppy, you make money. If it goes up, you make money. So that's how, yeah, you have higher chance of success. Yeah, naked calls only if it goes in your anticipated direction, then only you will make money. Yeah, you need less investment and high chance of success with the spreads.
Okay. Thanks, Kishore Garu. Yeah, I was not clear about the collateral, but yeah, this clears up a lot. Thank you.
Yeah. Santosh, please go ahead.
Uh, sure, Gaurav. I just have a couple questions. So, during iron condor, let's say if the support breaks or resistance breaks, what happens? Do we take losses?
Right, but your loss is still, that's why you are trading them on choppy days, right? When you think like the move will be generally right. For example, you are buying at a bottom
Hmm.
or you are selling at the top. Then generally
Okay.
it will, if it is a choppy, if there is no major event or something, it will stay in between the support and resistance. But
So it
let
will.
us say,
So
mhm.
go ahead, go ahead. Sorry, go ahead.
Yeah, let us say it broke support or resistance. Then minimum
Hmm.
your loss is right. For example, you are only doing a bull put, right? 64.40, 64.45.
Hmm.
Suddenly it dropped, right? Let us say you collected $150 because you are expecting price to stay above this. You did a bull put spread.
Right.
So now you collected $150. Your risk is 500 because the spread is 5 points difference. Your risk is 500. You collected $150. So let us say it broke the support.
Mm-hmm.
That means your risk is you are losing $350 for one
$350.
contract,
Yes. Yep.
right? But now instead of just doing a bull put, you are doing an iron condor where you are doing a bull put and also doing a bear call. So let us say you collected some 150, you collected some $100. So now you collected $250. If it breaks the support, what is your risk now? It is only $250.
150 plus.
Because
Yeah.
you collected 150, you collected some $100 here.
Okay. So
So
total
now,
loss is 250.
yeah, 150 and 100, 250, that means your risk is 500. Out of 500, you already collected 250. If it stays in between the support and resistance, then the 250 is 100% yours. But
Got it.
if it breaks the support or breaks the resistance, then your risk is
Mm-hmm.
maximum 250 per contract.
Got it. Got it.
So your
So
risk
for
is
iron
getting,
condors, what no matter what, it should stay below the prices, whatever the contracts we took.
it should stay in between the support, right? Okay, this is
Yes.
your bull put, this is your bear call. So it should stay in between your support and resistance. Then you make 100% profits on both the directions.
It is not for all days, only for chop video. Okay.
Yeah, for choppy days, this is best because if you take it on a trending, right, a very major event days, then your support can break or your resistance can break. So whenever Mondays and Fridays are best days for iron condors. Tuesdays, Wednesdays, Thursdays, you can do iron flies or you can do other strategies.
Got it. Thank you. The second question I do have is the trend lines. So, whatever the plans we have, do we see these trend lines? I haven't seen before. Just want to check.
Yeah, yeah. You will see them, yeah, with the indicators.
Is this a separate indicator, or do we have for our five indicator plan users or other plan users?
Yeah, you can select any indicator whichever you want. Yeah, this is MTF stock scan and future scan. You will see these type of things. Yeah, I
Oh,
made
in
some
the
modif.
background, the green and red lines showing downwards trend. Do we have those? Like, how do we see those? The trend
Yeah,
lines.
I'll publish this change. I made some changes to the stock scan. You will see this. Yeah, today.
Got it, got it. Thanks, thank you.
Yeah.
That's all I have. Thanks for your time.
Yeah, Lakshman, do you have any question?
Yeah, Kishore garu. Yeah, I have one question, Kishore garu. Yeah, first of all, Kishore garu, thank you for your explanation. It's very clear for me. And I have one question, Kishore garu. Like the spread calls, we have to wait until expire themselves, or we can close in between.
Yeah, we can close any time, right? If you're happy with 25, 30%, 40%, you can close well before. We don't need to wait until expiry. Right?
Okay.
For example, let us say you got an iron condor and you see that it went all the way to the top. Now you take profits on the bull put.
Yes.
Again, it started dropping, or you can let bear call expire. So yeah, you don't need to wait until expiry. Whenever you want for any option contracts, you can take profits whenever you want.
Okay. So can we put stop limit for these calls, like spread calls?
Yeah, yeah, you can. Yeah.
Oh, okay, fine. Thank you.
Yeah. Hey, Aparna, do you have any questions? We can't hear you, Dr. Aparna, if you're talking. Yeah, Ramesh, do you have any questions?
Hey, Kishore garu, thanks Andy. Can you show in Thinkorswim one more time butterfly or iron condor how to make this transactions?
Yeah, just you go here, right? If you want to do a butterfly or something, right? Or iron condor.
Uh-huh.
Whether if you are bullish, you select the buy
Right.
and you select iron condor, or you select butterfly if you are bullish. If you are bearish, you select sell and you do iron condor or butterfly. So you are collecting a credit.
Right. Okay. Thanks. And when you collect the credit, right? For example, in this instance, you collect 450 credit, and let's
Right.
say that it is making profit and you closed it, right? For let's say $200 profit you see, and I closed it.
Mm-hmm.
So how does it settles down? You 450 minus 250, or
Yeah, that's it. Yeah, if you are closing it with a profit even before the expiry, then whatever profit you made, that's it. There is nothing, no more settlement or anything.
right? Okay.
So you are buying back the contracts, right? Only if you leave it until end of the day, then they will see what is the current price, what is the closing price. They will do the settlement at that point of time.
And you
Mhm.
recommend this butterfly iron condor for the non-assignment like SPX for this, or any stocks also you can do it.
Yeah, we can do for any stock, but generally, if you want to avoid the risk of non-assignment, then yeah, SPX, XSP, they are the best tickets because you don't have any risk of assignment.
Mm,
But with PDD or any other stocks, right, because suddenly they go up or go down, suddenly sometimes they can get assigned, right? Because you can only take weekly expiry.
right, right,
Yeah. So generally, yeah, best thing is SPX is the best ticker to trade all these iron condors or butterfly. Or, there is no risk with any assignment of stocks. because suddenly if it gets assigned, most of your capital is blocked.
Right. Yeah, that's the issue.
By QQQ, you can trade, but you have to close them before end of the day, because on the day, if you don't close, suddenly if they assign this that SPY or QQQ, because the direction will be same. Only thing is suddenly, right, SPX closes at 3 p.m. So even though there is some earnings or something, suddenly it goes up again, or whatever happens, you don't need to worry with SPX. With SPY, it may go down, but suddenly there is some good earnings, and again SPY starts going up. You may get assigned those SPY and QQQ. So that's why, yeah, SPX, XSP, these are the two tickers where you don't have any assignment risk. So
Uh,
all,
yeah, and so one more question on the QQQ, right? So let's say that I collected a credit two, $300 on QQQ, and you said we need to close, right? So let's say that if you are at loss that time, $100 loss, you close it. What happens in that case?
nothing happens. Just you took a loss. That's it.
Okay,
There is, yeah. Once you close it, there is, you don't need to worry anything later. If you are just letting them expire, if they are just staying there, then you have a assignment, stock assignment problem.
right.
Yeah. So
But
again,
Kishore
butterfly.
garu, how does the stock assignment
Yeah,
happen
Kishore.
for a bear put or a bear call, right? How does that happen?
Again, if there is a big drop or big bounce, then there is a possibility they can, because you have two different legs, right? You are buying
Yeah.
a call, selling a call, or buying a put, selling a put. They
Yeah.
can they can keep one leg open and they can assign stocks on one leg.
Oh, okay, okay, okay.
If there is a major bounce or major, but if you are booking profits before the expiry, you don't have that problem. But suddenly, if there is any major jump on either side, there is a assignment risk.
Oh, okay,
That's why,
okay.
yeah, generally, yeah, SPX, XSP, you don't have that problem. It is purely cash settlement. There is no assignment of stock. So SPX is, if you just to follow SPX, and that is good enough for you.
Sure, I have one question.
Yeah, please go ahead.
Um, I have been listening to your sessions. I have one question wherein uh, the prop accounts. Uh, what I understand is there are they allow futures, but for options, are there any prop accounts which are available? Since I'm reading from India, it would be helpful because
Yeah,
I cannot have a personal account.
there is one company called tradefundrr.com, but yeah, those are generally expensive, and also there are, right, the advantage with prop firms is you can scale up as much as you want, because there are 30 to 40 prop firms which allows trading futures.
Mhm.
So if you are more of a swing trader, whenever you see this type of, right, you got a sell signal, there are a lot of sellers, it went to the top of the channel, T5 went to the top, you can sell, you can hold it. Again, you are at a support, you get a buy signal. So you can trade in multiple prop firms at same time, multiple accounts, multiple prop firms. So your advantage is high when you have lot of companies supporting the same futures, right? Every company supports ES, NQ, GC, Silver. But in
Mhm.
options, there is only one company, paidfund or .com. You put the URL. So you cannot scale up as much as you want. That is the problem. Uh,
Okay.
and also they
So,
are
so
expensive.
futures is the better options for me. Okay.
Right, futures is the better option, and also it is, you can trade nearly 23 hours a day. So
Mhm.
starting from Sunday evening, you can trade futures. So Sunday evening, that means, yeah, from India it is Monday morning, but in US it is Sunday evening till Friday evening. So even though you are working somewhere, you can take advantage of the prop firm trading with futures, where one is you are not investing your own money. Second thing is you can scale up as much as you want. Once you become confident, once you understand the strategies, once you see that, okay, overall it is in a downtrend. So if you get a sell signal, you are at a resistance, you have sell orders, that is the best opportunity. Or let us say natural gas or NKD is bullish. So this ticker is in a bullish direction. So whenever you get a buy signal at the bottom, that is the best one. You can ignore the sell signals. You wait for buy at the bottom. So you got a buy at the bottom of the channel. You have a support here. Then this buy would have made you $1,000 or $1,500. If you have some sell signal or you get a buy somewhere close to the top, you can ignore. You just do buy at the bottom. If there is a bearish ticker, right, crude oil, let us say it is bearish, right? By one is by looking at the score, you know whether it is bullish or bearish, or by looking at the channel direction, you know it is a bearish ticker. So now you got a sell here. You are at the top of the channel. You have a lot of sellers here. You got a sell signal. That's a perfect opportunity. Right? You can ignore if you don't want to take any risk, you ignore the buy. There can be some pullback. Again, it may go up, touch this, again there will be a drop. So every sell signal is a good opportunity to take shorts when something is bearish. You wait for sell close to the top of the channel. Whenever you get a sell, if you get a sell somewhere in the middle, you can ignore it. There will be a lot of you can put a notification on sell signal. Whenever you receive a sell signal at the top, you can easily make few $100. Or if it is a bullish ticker, right, natural gas is bullish. So whenever it comes to the bottom at a support, you see a buy signal, you make few $100. So again, you got a buy signal, it can break and go all the way up. So if you are close, if it is a bullish ticker, okay, it is not also bullish. Channel is pointing towards the downside, but yeah, you got it. So basically, if the ticker is bullish, if the channel is upside, you wait for a buy at the bottom. If the channel is pointing towards the downside, you wait, you do the sell signal at the top. So
Okay,
yeah, that is
so
a
I have
good.
to look at
Mhm.
I have to look at the bullish and the channel if it is in the upward direction, and at the same time I should also get the buy signal. So all
Right,
the confluence of these would help. So that is what
right, yeah. If you take with the confluence, your chance of success is very, very high, right? If it is a bullish, that means it has lot of demand. If something has lot of demand and you are buying at a bottom, you have 90%, 95% chance of making money. Or if some ticker is bearish, that means there is lot of supply. The people are ready to sell it off. You see lot of sellers, big companies are selling it off. You see a sell signal close to the top of the channel. Right here, there are a lot of sellers. It went to the top of the channel, there was a big drop. And then there was some bounce. Again, you got a sell signal, again big drop. Again it went up, again it dropped again. So you can ignore the buy signals, just focus on the sell opportunities if something is in the downtrend. Like that, yeah. Same thing you can do for stocks, options. If SPX is in downtrend, you look for sell opportunities. You can buy the puts, you can do the debit spreads, you can do the bear call spreads, or like that. You can focus if it is in downtrend, you mainly focus on the reverse side trends or sell side.
yeah. Thank you, Kishore.
Yeah.
Okay, so Dinesh here. So when you were showing, how many indicators do you have on the screen right now active? I see the T5 and the stock scan. Is there any more?
No, I have only two now. Yeah.
Okay, so now can the stock scan do the future scan or vice versa? Or do we need
Uh,
both?
yeah, you need both. So future scan will show you the buy and sell signals for all the future tickers. Stock scan will tell you the buy and sell signals for all the stocks.
Okay, okay. Okay, one more question, Kushugaru. There was one more, the SPX daily income indicator. Do you have like 2 minutes to just show that indicator at all?
Sure.
I was in the process of selecting those. I said, let me check with you before I waste your time.
I was trying to make some changes to this. Let me.
So this will automatically show, right, where to buy and sell.
This SPX daily income will basically show you what to do, right? Around 9 o'clock, it will tell you what is the best strategy for the day. So it will tell you, right? For example, on Friday, it gave indication that better you do the bear call spreads. That means overall trend is bearish. You can do bear call spreads on this day. So whenever you see a pullback, it is best to do bear calls on this. So whenever you see a sell signal,
Does it keep only at 9 o'clock or all through the day it'll keep telling?
no, at 9 o'clock, right? It is a daily income. That means at 9 o'clock you can go up and you can just sell the bear calls here. So you
Okay.
can that means price will stay below that price. Then you don't even need to look at the chart, right? For example, here on Thursday it told bull put spread. You can do bull put spread. You go a little bit below, do the bull put spread. That means price will stay above that by end of the day.
Okay. And what does it say at 20 delta? What does that mean?
20 delta means, for example, now it is 64.48. If you sell 64.48, that is like 50 delta. That means there's a 50% chance price will stay above that. So 20 delta means you will go a little bit below. Wherever you make around $100 credit, you will collect that, right?
Okay.
So here you collect 250, here you collect 200, here you collect 150, here, right? If you are selling 64.35, 64.30, you collect around $100. That means price will stay above that. So you are selecting, which is that means 80% chance you will make money with it.
Okay,
So
okay. So
you
at 20 delta means, okay, the reverse, that 80% chance and 20% of losing. Okay. Got it.
right. So here,
Okay.
if it is saying bear call spread, that means you'll go here and you do some bear calls above this. Then you'll 90% of the time price will stay uh, below that zone.
Okay. Okay. All right. All right. Thank you, Kishore. That's it. Yeah.
Yeah, Suresh, please go ahead.
Hi, Kishore garu. Thanks for explaining all these things. So one question, actually, I'm new to this option trading. So what is the best trading platform to do the option trading? I'm using Robinhood, but it seems like you are using Think and Swim. What do you suggest?
Yeah, Thinkorswim is a better platform to do options, especially SPX and others. You get a better prices, better credits. Robinhood, sometimes they close things much early and you don't get a proper fill. So yeah, Thinkorswim is a trade station, Tradier. Those are the best ones.
Okay, okay, sure. And one more thing. So for use for having this selling calls or selling like puts, do we need to have like a maximum capital like 20 to 25K or like even
Yeah,
we
if you,
can
if you have to sell naked calls, naked puts, you need a huge investment. But you are doing a bare collar because that means you are buying and also you are selling. So
right.
you don't need much capital. If you are just selling a naked call or naked, right? If, for example, if you are going and selling a 118 put
Mm,
because you are assuming that it will stay above 118, then you need lot of capital. That means you need to have capital equal to 118 into 100. Even if you want to do one contract, you need to have that much money. But if you
Okay.
are selling 118 put and you are buying some 115 put, that means all you need is $300. Whatever is the spread difference, only that much money you need to have. You don't need to have huge capital because you are also a buyer, right? You are selling 118, but you are also buying 115, so that suddenly it drops, you have a protection.
Okay.
Yeah, when you're doing a credit spreads or debit spreads, you need low investment. If you're selling naked calls or naked puts, that is very risky, and also you need lot of big capital.
Okay. Whenever we are doing like a naked selling, then only we require more
Yeah,
capital.
more
But
capital.
okay. But doing any iron condor or butterfly or any debit spreads or credit spread, you don't require any more capital, right?
That is right. Yeah, because that's why it is called as a spread. You are taking a low risk because you are a buyer. You are also a seller.
Okay. You said something like assignments of this stocks, right? For SPX, they won't do any assignment if you're going to do like selling put or selling a call.
That is right. Yeah, SPX or XSP is 1/10 of SPX. Yeah, for those two, you don't have any assignment risk.
Assignment is. So in that case, can we do like a bull naked selling of those stocks for SPX? Will it require any maximum capital?
Yeah, for any naked selling, you need a lot of, right? You need to, right, because its cost is 6,450. So you need to sell one contract, you need $64,500 for one contract. So yeah, you cannot do naked call, or that is very risky also with SPX. So you always do a credit spread or debit spreads, then your risk is less.
Okay. Okay.
Then
Got it.
if you have some millions of dollars in your trading profile, yeah, you can do naked sell, naked calls or naked puts. But suddenly there is a tweet or something from Trump or something, right? Then your risk is so much high.
Mm.
So that's why, yeah, never sell naked calls or naked puts. Always a bull put or bear call will reduce your risk.
Okay. Can you give me one example, like for doing iron condo for SPX, how much capital is required for the Monday? Just would like to give a try.
Right. So for example, let us say it opens, right? Let us say tomorrow morning, let us say, right, after first 30 minutes, we are somewhere here at 64.35 or
Okay.
64.34, right? You are at the bottom of the channel, you are at a support, and your resistance is somewhere here. So you do a bull put below this, and you are collecting some premiums, and you do a bear call above this, and you collecting premium. So you need $500 here, you need $500 here. So $1,000, with $1,000 you can do one contract. You are
Okay.
collecting around 300 to 400, $300. Let us say $300. Some $200 at the bottom, $100 at the top. So if price stays in between this support and this resistance, you make all the $300. If it goes completely down below this support, chances are very less, but let us say if it goes all the way down, your risk is 200, because right, so as long as it stays below this price, all that money is yours.
Right.
If it stays above this price, all the money is yours. But if it is either going all the way up or going all the way down, then one of the legs you have to take a loss. But if it stays between this resistance and this support, then all that money is yours. So your maximum risk is
$200.
$1,000, 1,000 minus whatever credit you are collecting, right? Let us say you collected 200 and 100. That means 700 is your risk, 300 is your profit. 300 you can make 90% of the time. But if it goes completely up or completely down, one leg you will make profit. If it goes completely up above this,
Mm.
from this leg you are making profit. But on one leg you are taking a loss. So yeah, your loss will be maximum 400 to 500, but if it stays in between, you will make $300. One of the legs definitely will make profit. If it stays in between, you make profit on both the legs. If it goes completely down or completely up, one of the legs you lose, one of the leg you make profit. You will have a loss. That's why we take it on choppy days, or Mondays and Fridays are the best days to do iron condor,
Okay.
because
So,
generally those days you won't have any major events or major reports.
okay, Andy. So one more thing, Andy. So I won't do a day trading, Andy. So it seems like you are having some kind of live sessions, but are you giving any messages in our Telegram channel to take these kind of calls?
Yeah, we have one channel, right, earnings channel, where we give both swing trades and earning trades, which are mainly for swing trading. Then there is one channel where we mainly do day trading. So, for example, we took ETHA 19 calls. Now it went to nearly $33. So we made nearly 500-600% profit. We have many swing trades. We post all the swing trades in one channel.
Okay, actually, I'm new to this channel and new to this session, Sunday. So I'm part of two Telegram channels, which is like RCA Algo Bot Alerts, RC Premium Ninja Trading Bots. I'm in only these two channels. Is there any other
Mhm.
channels do I need to add?
No, with indicators, those are the two channels. With indicators, you learn how to take the trades, or how to. So, for example, if you want to take swing trades, you
Okay.
use 1 hour time frame, and you can see, right, for example, PDD. In 1 hour, you can see up to what price it can go, right? You have around 122 or like that. In 1 hour, you look for the buy signals, you can buy the calls, you can buy the stocks in higher time frame. So
Okay.
you got it around $112, it went all the way to 122. Again, there is a pullback, again it went up. So if you have indicators, you learn how to take the trades by yourself. If you are parts of alerts channel, then that is where we give the alerts. But they don't, right? If you have indicators, the advantage is you can use for stocks, options, futures, currencies, forex, whatever you want, you can do by yourself. Otherwise, yeah, if you have to take alert channel for options, you have to pay something, stocks, you have to pay something, forex, you have to pay something, cryptos, you have to pay. But yeah, once you learn, then you are completely independent. Whenever you are free, you can take the trades. You are free in the morning time, 6 o'clock, you can take trades. If you are free in the night time, you can take trades like that. That is the advantage when you have indicators.
Okay. Okay. Andy. Got it. Thanks, Andy.
Sure. Yeah, Manipal, do you have any questions?
Yes, I have one question. Can you hear me?
Yeah, please go ahead.
Yeah. Thanks, Kishore Garu. So you are showing this all indicators in TradingView, right?
Right.
Can we set up the same indicators in Thinkorswim or Sim?
No, Thinkorswim has limited functionality compared to TradingView. So yeah, mainly we focus on uh, TradingView, because here you can yeah, integrate with a lot of things, and you have much more flexibility with Pine script compared to ThinkScript.
Okay.
So yeah, we have some indicators, but the indicators in TradingView are much more powerful, much more effective
Okay.
compared to
So we
Thinkorswim.
need to set up these indicators in TradingView only, and then based on those signals, we need to take the trades on the Thinkorswim
Right.
or any other platform. Yeah.
That is right. Yeah, there are some brokerages which you can directly connect here, right? You have TradeStation, Tradier, Tradeovate, or Webull, where you can directly buy stocks, or you
Okay.
can buy futures.
Not Thinkorswim or like Charles Schwab.
Right. Yeah, I think Thinkorswim doesn't have a API with TradingView, but yeah, there are other brokerages.
Okay.
You can connect and directly you can buy, sell here. If you see some KWeb is bullish, you can quickly buy stocks here, and whenever you see a sell signal, you can sell them.
Okay, got it. Yeah, thank you. That's all my question.
Sure. Yeah. VS, do you have any questions?
Hey Kishore, can you hear me?
Yeah, please go ahead. Yeah.
Hey, thanks a lot for meeting me, and thanks for all this explanation. Again, I'll be new here. I think I might have spoken to you earlier, right? If I want to get started, right? Let's say in 2 weeks time, right? So how do you? What is your recommendation? How should I get started? So low risk, but see some profit and then move up from there.
Right. So again, you have two different options. One is if you want to trade in your personal accounts, you
Mm-hmm.
can trade stocks, options, futures, whatever it is. You open your brokerage account, and then weekly once we do some demo sessions, or you can watch the previous recordings, and then you can understand, you can start. That is one way. Or there is one thing called as prop firms, where you connect to some prop firm accounts where you don't need your own investment,
Mm-hmm.
right? Those prop firms will give you the money to trade, but before that, we need to prove that you can make profits. So
Okay.
you can start with those prop firms, and so the advantage with prop firms is, one is you don't need huge capital. Second thing
Okay.
is you can scale up, because there are 20, 30 prop firms. Each company gives you 5 accounts, 10 accounts, 20 accounts. So as long as you follow the process, you can use the same thing, right? If ES is looking bearish, then you wait for a sell signal, you take the shots whenever you get a sell signal on ES. So here it went to the top, it started, you got a sell signal, it came on, right? There are a lot of sellers here.
Mm-hmm.
So that's a perfect sell opportunity. Your channel is in a downtrend. So you take the sell signal, you make profits. Or you see something NKD is bullish, your channel is in uptrend. So whenever you see a buy signal, you do the buy. And then once you clear your evaluation, they will give you the real money. You can trade, and you can make 80 to 90% profits on whatever profits you make.
Okay. Great. But these prop firms are just for the futures. I believe you mentioned that, right? Early in the call.
Right, prop firms are mainly for futures. Yeah.
Okay. And I also work, maybe many of them out here might also be doing the same thing. So, I work full time. Uh, so with that said, like, you might get a couple of hours in a day, during a daytime, like, break or whatnot from the work,
Right.
and
If
a
you
couple of hours
spend
during the
one,
evening time. Go ahead.
yeah, every day 8 to 9 p.m. we are making 500, 600, $800 every day,
Okay.
just between 8 to 9 p.m. Central. We have live sessions.
Okay.
We use the same strategy, 31 minus 31. If something is 31, we look for buy signals, we take buy
Hmm.
opportunities.
Awesome.
So yeah, if you can spend that 8 to 9 p.m. Central every day,
Sure.
you can make some nice gains every day.
There'll be a live session with you, right? So you'll guide us with that, or you'll show us like what needs to be done. That's
Right.
what you're
Yeah.
saying.
Initially, yeah, you can join them. Later, once you become comfortable, then whenever you are free, if you are getting up at 5 a.m., 6 a.m., whenever, you don't need me to tell you, right? First
Okay.
few days, you will try to understand, okay, because score is 31, we got a buy signal, we have some buy orders, like that, you
Sure.
will, yeah.
Cool. So, couple of few questions. Sorry for that. One is like, what all service do I need to buy from you? I mean, I know there's a trading view indicators. I need to buy T5 from you. Or it's a monthly subscription, yearly subscription, and how much it cost?
Yeah. So as
And
I
is there
said,
any kind of a deal going on right now that I can jump on?
so one is, yeah, you can buy the indicators. So you can trade everything. You can join the live sessions. You can attend all these training sessions. You can
Okay.
learn about stocks, options. So we have a three indicator plan. If you are only focusing on futures, then three indicator will be sufficient. If you are focusing on stocks, options, futures, then five indicator is good.
Okay.
So yeah, three indicator is 349 per month. And yeah,
Okay.
once you watch for 1 month, you can continue. So there are a lot of members who are converting to 6 months annual plans. So we have
Okay.
nearly 450 subscribers.
Sure.
So they are changing. So there are a lot of members who are making 20K, 30K, 40K per month. So
Sure.
it's all about that emotional balance, right? You wait for, you don't jump onto every signal.
Got it.
You try to understand the concept, understand the strategy, and see that okay, it is bullish or bearish, right? If ES is looking bearish, you only focus on the sell signals.
Okay. So
Then,
there'll be some training, or you'll have some training videos from basic to intermediate advanced kind of thing, right? Which you'll provide to us once we buy
that is
these
right.
indicators.
Right.
And
And
then how
also,
about the fine? So go ahead.
yeah, and also we have daily live sessions where
Okay.
again that every session is like a training where
Awesome.
okay, I tell you that okay, here it is bearish. We have T5 at the top. We have a lot of sellers here, so we
Yep.
can take the bear. So at the same time, you make money with prop firms. You can make with SPX. You can make with SPY. You can make with EQQ. You can buy puts here. You can buy. You can short ES here because every futures contract has a corresponding ETF.
Okay.
So if
Makes sense.
GC is going up, you can buy GLD calls. If silver is going down, you can buy silver puts.
Mm.
If ES is going down, you can do SPX pair calls or SPX puts or SPX credit spreads. So yeah, at the same time, you can make money with prop firms. You can make money in the personal accounts.
Mm-hmm.
But yeah, only thing is we need to just wait for right signals or based on the trend. You see the confluence. Okay, here it is at the top. Here you see a lot of sellers.
Yep.
Here you have resistance. Then there is a perfect opportunity for a short. We did
Got it.
multiple bear calls. We made nice profits. So again, we took a bull puts here when it came all the way down.
Mm-hmm.
So like that, yeah, you can
Awesome.
take time to learn, and then you can multiply your profits with different prop accounts.
Cool. And 5 indicators, how much will that cost per month?
For indicators 449. The indicators
449.
is 349. But in
So
one
5 Sorry, go ahead.
one
So
or 2 days, yeah, you can get that money back.
no, makes sense. No, you have been trading awesome. So 5 indicators, if I buy this, right, 449 per month, with all the tradings that I can. I mean, is it something possible that you can share the trading videos upfront before I sign up for this, for this account, 5 indicator account, so that I can get trained before I sign up, and then I can get started at least, with your help, daily sessions as well, and then all those training videos.
Yeah, generally, yeah, once you become a member, you get all those training links.
Okay, that's fine. And is this indicate or are these indicators also applicable to Indian stock market as well? If
Yeah,
if my brother from India wants
it
to get
is.
started.
Yes, yeah, you can right. You can trade anything because the concepts are same for any instrument, whether it is forex, currencies, Indian stocks, futures, anything. If it is bullish, buy at the bottom. If it is channel is pointing towards downside, sell at the top. If you see a lot of sellers, so yeah, you can use it
Uh,
with anything.
sure. My question was basically, I can track the Reliance stock here or HDFC stock
Mhm.
here as well, right, in this trading view platform.
That is right.
Okay, cool, cool. Yeah, yeah, concept would remain the same, but I just wanted to make sure that all the world stocks are available, or at least India and US stocks are available.
Right.
Awesome. But then if someone from India wants to buy this, like, is there Indian currency cost to this, or they will convert to dollars and then buy it, the
Yeah,
indicators?
basically convert to dollars and buy because we
Okay.
cannot validate where they are or all those things. So yeah,
Okay. Okay.
basically because futures, currencies, everything is global markets. Anybody can use prop firms, right? Even though they are from India,
Yeah.
they can do prop
They
firms.
can use it. Okay. You don't need foreign, US bank account and all those stuff, right? In that case, are you saying that?
That is right. Yeah. If you have a PayPal account, also they will transfer money to PayPal account if you are
Oh,
from
okay.
India.
Okay, cool. And I know you, sorry for a couple of questions here, but I know you always send some deals for the prop firms. Is there anything going on right now, some kind of a deal on the prop firms that I can catch up on?
Yeah, there are many deals going on. So especially Take Profit Trader is one of the best companies who will do
Okay.
daily payouts once you complete evaluation and make some buffer amount.
Mm-hmm.
So they have 40% off, and whatever you initially pay, also they will return with your first payment. So yeah, in addition to that, yeah, there are more, yeah, different platforms have different discounts. So I'll share that in the premium the channel to all the members.
Awesome, awesome. And one thing that for last few days I've been seeing, or maybe it might
So
be
what
earlier
I
than
think
that.
is HDFC Bank can happen tonight or once India market opens.
Correct.
Do you think
Oh,
it will go up or
yeah, it's a uptrend, so looks like it should go up from these indicators.
right? Yeah. Well, there are a lot of buyers here. It is at the bottom, so
Yep.
there is a high possibility. If you want, we can also go and change. Yeah, as of now, it is in a consolidation, but if consolidation breaks, then yeah, as of now, score is -3 because it is in a sideways
Mm-hmm.
for time being. But if it breaks this, then yeah, it can go all the way to minimum base. It can break.
So that red band is a seller band, and that down below blue band kind of is a buyer band, right?
Mm,
Where you have
It
more
is
buyers,
right.
right? Okay.
Yeah,
So
if
if
it
you wait
touches it,
for if we wait to touch somewhere there and we buy a bull put kind
mhm.
of thing, then we tend to profit probably through these
That is
indicators.
that
Okay.
is right. You can do
Yeah, I'm
bull
just trying
puts
to
below
understand.
this.
Okay.
Right.
Oh, below that, sorry, my bad. Yeah. Okay, cool. Okay, thanks. One more thing I was asking, yeah. There's some firm like Algo Plus and something which trade on your behalf for this prop firm so that it can put you on track, for the evaluation thing. Do you think one should sign up for that, or just through these indicators you do it by yourself? You know what I'm saying? Because there's an
Yeah,
evaluation
I know,
period
but
that the prop firm.
generally prop firms will deny the payouts if they see that someone else the trades are
Ah,
getting copied or something. So you waste time and you waste all the money. And
got it.
if they'll sometimes they ask questions, what strategy you use, share a video, such type of things. So
Okay,
it's
so
better because
suspicious.
once you learn, you are becoming 100% independent, right? You don't need to depend on someone for your success.
Makes
Once you
sense.
take time, learn, then you can use it for stocks, options, futures, prop firms. You can teach to your spouse, your kids, right?
Yeah,
Everyone will become independent. You don't need to depend on job market or visas, all these things. So
got it,
that's
got it.
where instead of trying to, because yeah, right. Prop firms are very, very strict. That's where you sign the agreements initially that you are a
Okay.
non-professional, you are trading, nobody else is trading on your account, all those things you sign. So once you make all the profits, suddenly if they reject the payouts, then it is waste of all the money you spend.
Yeah.
So
Okay.
that's why it is better you learn than yeah, it is.
So if what you're saying is there any questions on what's your trading strategy, you can always share this trading view platform and all these indicators on based on what you are making a decision, and then
Right,
that might
right.
fulfill
Yeah,
the
that
requirement or whatnot.
gives them a confidence that you are trading and you know what you are doing.
Yeah, independent trading. Okay.
Right.
Okay.
Because if they are doing the same thing for hundreds of customers, if they see that some, right, they have the algos or they have the bots to identify if some copy trading is happening.
Got it.
If they see same trades are happening in 100 machines, then they will reject the payout because the prop firms will see for reasons to reject the payouts.
Hmm.
Right. If they identify a small reason also, they will cancel the payouts.
Okay.
So that's why it is better you take time to learn, even though it may take few days, few weeks, but
Sure.
whatever you spend is worth it because whatever you make in a job, you can make it in a 1 week here, whatever you make in 1 month.
Just spend a couple of hours in a day, maybe in evening hours or something, at least for these futures, and you can start
Mm,
learning and you can spread it out. Okay. Cool.
mm,
And what you recommend is start with one or two prop firms, or maybe just one prop firm, understand the concept,
Right.
get to the intermediate level or advanced level,
That's
and then once you feel confident, start putting up more prop firms.
right. Right.
Okay, cool. Thanks a lot, Kishore. Really appreciate. If required, like I'll contact you separately as well.
Sure. Yeah. Bunny, do you have any questions?
Hi, Andy. Hi, Kishore. So, quick question now. So, when we try to buy net calls, what should be the strike price? For example, if PDD is like some amount, like which is the good where we should buy?
Generally, you can buy, right? For example, if the current strike price, right, current at 119, So you can buy close to that strike price. So you see a lot of buyers here. So you can buy 118, 119 strike price.
Okay.
That's where you will make nice price. If you buy too much far away, right, out of the money, 120, 125, you will make very less even though it goes up, you'll be making less profit for even though it is moving up. But if you buy 118, 119 call, you will for every small move up, you will be making nice profits. So
Oh,
generally, it is always better you buy close to the current price.
okay. And one more question, like, which stocks are eligible to like buy options? And for example, we have like a lot of biotech stocks too, right? And like, should we consider high volume stocks only or?
Yeah, it's always better you go with high liquid stocks or well-known stocks because there are a lot of small companies, small caps. Suddenly, there will be a lot of pump and dump,
Okay.
right? They will suddenly go up 50, 100%. And
Mm.
suddenly, within a minute, they will dump 100%, 150% down.
Okay.
So it's always better you focus on good company stocks like Netflix, Apple, Microsoft, or minimum you should know, okay, what is the business, what they do, right? If you know, okay, Baba or PDD or JD or some well-known companies, and if the stock price is above 25, 30, it is much better. That means they are medium cap or large cap. If the stocks are $1, $2, $3, they can be suddenly they right a big company can suddenly dump them within 1 minute. They can drop it 50, 60% down.
Okay. So one more question related to the forms, and I recently opened an account in Take Profit Trader. So I did some trading on August 14. So there is a day in daily journal on that. There is one column COMM and it says like -$20. What does that mean?
That means they charge some commission out of your profits. If you are making some $100 profit, right?
Okay.
Because if you buy a contract in Think or Swim or any personal account, they for every buying it for selling it, they charge some $2 to buy a contract to sell a contract $2. So here you are not paying real money, but whatever profit you make, they are charging some commission out of that.
Okay.
So that right, they don't want somebody to for every small tick you are buying and selling for $1, $2.
Mhm. And I read the rules and they are saying not to trade when we have some news. But on the other day, we did some trading when we have the reports right now. Will they consider those? Because they say like we should not trade before or after the reports for a couple of minutes. Oh, I said,
When you go to stage 2 and stage 3, you should not trade those news events. But when you are in the evaluation phase, you can take the risk and you can trade. They will consider it. But
okay.
when you are in the stage 2, stage 3, because for example, if you have two pro accounts, you got two pro accounts, and you let us say you took a long on one, short on one.
Mhm.
You may make $10,000 on one. You may lose one account. You pay 1,500. You can reset it again.
Okay.
So people can exploit that by taking two different directions on the pro accounts because
Oh,
there will be a big move with that CPI, PPI, or those events. So evaluation, yeah, you can they will allow, but not for the pro or pro
and there is
plus.
one more rule that once we take a trade, it should be like more than 1 minute. Is that really applies? And because I saw your videos there. So you sometimes you do it very quickly, right? When you buy one option and above like two, you will again sell it, right? But
Right, there are some, yeah, in take profit trader you can do that, but there are some prop firms like My Funded Futures or yeah, where they want you to minimum hold for 1 minute. So this particular indicator is good for where you can hold it for longer time. Right here you can so whereas our futures level manager they are mainly for scalping. You buy if it is a bullish ticker, you buy at the bottom, you sell at the top.
Mhm.
Whereas here, right, if something is bearish, let us say ES is bearish, right? Your channel is in the downtrend direction.
is MTF stocks can will work for futures as well?
No, MTF stock scan is mainly for the stocks, but yeah, you can see the buy signals and sell signals, but for scoring purpose, it will work only for stocks.
Okay.
But yeah, right. For example, here the channel is in the downtrend. If I went to the top, you got a sell signal.
Mm.
Then you can hold the trade until it goes and touches support zone. You can hold it with one trade. You can easily make $1,000 or more. So this is mainly for yeah. Or you have a bullish ticker. Let us say you got a buy signal. You can hold it for long time. So
Okay.
again, you got a sell signal. So if you get a buy signal at the top, you can ignore it. You got a sell signal. It touched a major sell block. You can short it. At the bottom, we can do buy, or generally it is, again, if you don't want to take any risk, only for bullish tickers you will do buy at the bottom. For bearish tickers you do sell at the top.
Yeah.
Yeah, you can use this technique for prop firms which will not allow you quick scalping. You
Okay.
can take a trade, hold it for longer duration.
Okay. Thank you.
Hmm. Yeah, hey Sridhar, do you have any questions? Yeah, Chintan, do you have any questions?
Hi, Kishore.
Yeah, please go ahead.
Can you have any tutorial for like cover calls?
Yeah, just like cash secured puts or right, for example, so PDD I gave you an example for right. So if you see PDD,
Mhm.
the stock is bullish. So you can either do bull put spreads, or you can even do cash. If you have a big account, you can even do the cash secured puts, right? That means you are selling 115 put and you collect the premium. As long as stock stays above 115, all that money will be yours. Right? That is a cash. If your stock is bullish, if you have a big account, you are selling a put and collecting the premiums. If stock stays above that price by this Friday, then all that money, if you collect $100, $200 for every contract, all that money is 100% yours. Whereas if something is bearish, right, let's go to something like, so, or let us say you have some stock like SYXL, right?
Mhm.
So, you know it is a good company stock, you bought it and you are holding the stock. So instead of just holding the stock, waiting for price to go up, so where do you see the price, right? It may not go above this week, right? Around $28 or $29 or so. What you can do is you can sell you have already some 100 stocks or 1,000 stocks. Now you
Mhm.
go, there is a strong resistance around 28. You go and sell 28 call and collect the premiums. That means you are telling someone that even if it goes above also, you are ready to sell them at 28. You are collecting the premium. So it is just like you bought a house. Instead of just holding it for price to go up, you are renting it. In the same way, you have some SYXL stocks. Instead of just holding them for them to go up, you know that price will not go above 28. So you sell 28 or 28.5 call and you collect premiums. And then if stock is staying below this, all that money is yours.
But can they do the assignment, or like kind of like if someone else they just want to buy it, then what happened?
No, as long as stock stays below this, there won't be any assignment. If stock goes above that, then they can do the assignment. But if stock is staying below the 28 price,
So like by Friday, because this is like weekly, right? Like by Friday, if it reached $30, just in case, okay?
right, then they can assign, right? Basically, they will assign that short to you. So if you have stocks already, They are
Mm-hmm.
taking the stocks in your account and giving it to that person.
What price they will sell it? Like they will sell it at 28 or like how it gonna work?
Right. Wherever you are collecting the premium, if you are selling 28 and collect, or you sell at 29 and collecting some premiums,
Mm-hmm.
then instead of selling at 27, now you are selling at 29 and you are collecting premium. Right? Let us say you bought at 29 or something.
Mm-hmm.
And suddenly stock went down. Now
Mm-hmm.
instead of taking a loss, you are going and doing, you are selling a call at 29 and you are collecting some premium. So that means if it goes up, also you are making profit. If it goes down, you are collecting that rent. You are collecting those premiums will be 100% yours. So if
Okay.
you are bullish about a stock, you do the cash secured put. If you are
Mm-hmm.
bearish about a stock, you are holding a stock, you do the covered calls. That means you are holding the stock just instead of just holding it, you are collecting some rent on that.
Okay. So I receive premium plus, like if I buy at 27 and if I sell the 29 one, right, for this
Mhm.
week.
Right.
So I'm collecting premium plus $2 or just premium?
Now you are collecting premium. Suddenly, if it goes above 29, then they will assign. So then you are receiving $2 plus premium.
Okay. Okay, no problem. I just want to
So,
understand that I receive only
right.
premium or I receive $2 as well.
Yeah, you will receive $2 as well. So because you are telling that you are ready to sell them at 29
Mm-hmm.
Citizen too.
and you are collecting premium. So only if
Okay.
it stays below 29, the premium is 100% yours. If it goes up, the premium plus that additional $2 is yours.
Okay, no problem. Thank you.
Even though it goes to 30, 31, whatever it is, your stocks are getting sold at 29.
Okay. Okay. Also, I send the message to the like trading bots for um, yearly subscription. So can you just look into it whenever you have
Yeah,
time?
sure. Yeah,
Yeah. Thank you.
sure.
Kishore garu,
Yes, Sunil, please go ahead. Yeah,
happy Sunday. Good morning. Sir, I have bunch of questions on the stocks piece.
sure.
First, I will start with the last one. A couple weeks back, Monkey, I had couple stocks during the put options that got assigned, the MOH and the R. I'm still holding them. First question, I was debating to figure out the covered call aspect, but the way it got assigned, I was little worried whether if it will cross, then I will still take it. In those, again, not, I'm just taking this as an example. In
Right.
those kind of scenarios, can we still use these indicators to feel comfortable that, okay, even if I, on Monday, for ARM, for example, we see that, okay, I have sellers at 149 or something, but my stock value is 150. I can still 153. I can still do a 148 covered call, knowing that potentially it might not go there. And then once it is dropping from there back again, I try to take some profit and start recovering from the 153. And as soon as I see it is break even, I can just either sell it or come out of it. Is that a good strategy?
Yes, Sunil. Yeah, that's a good strategy. You can, right, if you want to keep collecting a recurring income, you can keep doing that covered calls, right? For example, you got MOH stocks. Let
Yes.
us say you have, right, it may not go above 170 or 165. You have a lot of sellers around that region.
Okay.
So you can go and sell 170 covered call. You, let us say you have 500 stocks. You sell
Hmm.
5 contracts and collect the premium. And if stock is going there and again dropping, then all that premium is 100% yours. You can keep
Got it.
repeating it until you. It is just like buying a home and collecting rent every month.
Yeah. So that is, yeah. So my second question actually is more related to, I mean, I know recently we started doing a lot of options on the stocks, especially after the new indicator becoming more comfortable for us to do. Now, I know you watch a huge list, just like our levels in manager. Can we include all the stocks either for that particular day kind of a file and use it rather than just a static set of stocks?
Yeah, that's what generally, right? If I see some potential stocks for the day,
Uh-huh.
right? I share that list in the premium, right? I said
Correct,
UNH.
correct.
If
Yeah. So that's the list we can import into the stocks level manager to track them, or I thought that was more for the just the MTF indicator kind of a thing where to input. That's where I was confused. I know I started seeing it. I haven't checked it out, like because almost like 2-3 months back you gave your total stocks that you are observing. So, but I know now that stocks list has increased by a lot. So is there a new stocks watch list that we can import in our trading view, or how do we follow with the stock options, stocks that you are watching?
right, one is we have a top 100 stocks of Nasdaq and S&P 500, which are
Yeah, I
the
think
major
that's, yeah,
liquid stocks, which I already shared the list. And then
correct.
based on multiple factors, based on earnings or based on different reasons, there can be some 5 to 10 stocks which can either go up or go down, right?
Okay.
So, for example, all the stocks we were looking for. So, whenever you see a sell signal on any of these stocks, right, on MAT we got the puts, or RBLX we got the puts, like that. I share that list on a daily basis in the premium
Correct.
channel. If I see
So
that,
where
okay,
do we
this
import that list? That's my question basically.
in the trading view, just you can import it in trading view and you can put alerts
Oh,
on.
so okay. Just like our okay. So that's a watch list more than a indicator list. Okay, I got it. That's what that was the question I had. Okay, so now that answers my second question. So my third question is, if I'm using either Think or Swim or Webull in one of these two, I just started my account on Think or Swim, but I have Webull. I'm trying to go out of Robinhood so we can do more of the spreads much easier. Like what's a recommended liquidity that you would say we should start with, so that we are I mean I don't know how many members here have listened to one of the session where you actually gave a breakdown of how we should take the dollar value and use the same value for all the options, rather than because one ticker you put more and you don't know another ticker you put less, and that you remember that session, Kishore?
Right, yeah. Position
Yeah, so
sizing.
I'm trying to follow that session and say, okay, even if I'm taking an SPX also, I want to invest only, like my risk should be $1,000, whether I take an option, also try to keep the same. So in that context, like what should be a good fiscal dollar value I should think of?
If well, let us say your account size is $30,000, your options account size portfolio, then
Okay,
you spend $1,000 for every trade.
got it. Okay.
So yeah, divide them into 25 or 30 parts, whatever is your portfolio, and use one part for each trade. So that even if we make 8 or 9 out of 10, then yeah, you will be in profit at the end of the day.
So which means that because on a normal trading day, we do at least 4 or 5 SPX transactions, right?
Right.
SPY or SPX. So even those, each trade you would recommend is like $1,000. Is that a fair statement?
Right. You will risk the right. For example, let's take again SPX. So let us say we are doing a bear call spread tomorrow morning. Right. Let us say we are doing 64.50, 64.55, and let us say we are collecting $200. That means what is the risk per contract?
Uh,
So we are doing
yeah.
64.50, 64.55 bear call and collecting
$200.
200. That means
Yes. Yeah, that's $300 risk.
right. So you can buy 3 contracts. Or it will be
Oh,
dropping
okay. Got it.
all the way to the support, right? Let us say it came all the way to the support, and you
Hmm.
have some $200 premium for the bull puts. Then, yeah, 200 or 300 or $100 for the bull put. Your risk is 400. Then you buy two contracts. So whatever is the risk, whether you are, or let us say you are buying naked puts and it is $20, right? Or let us say $10
Yeah.
for a put.
Hmm.
That means 10 means $1,000. You buy one contract of
Oh,
naked put.
got it. Okay.
So always your risk is $1,000 on any trade. So out of 10 trades, even if we win 7 or 8, you will be profitable at the end of the day. Yeah, whether we are buying
Got
calls,
it. Yeah.
doing splits, whatever it is, our risk should be maximum $1,000 for any trade.
Yes.
If you have a 30,000 account, if you have a 300,000 account, spend $10,000 every trade.
Got it. Okay. And the same, if I'm trying to build a personal account for futures. Um, in because if I'm just doing micros, even if it is 4, 5,000, 6,000, it's okay. But if I really want to do like what we do with prop accounts, what's a good starting amount?
Again, there you take the stop loss as a risk, right? $1,000 risk,
Yes.
or whenever
Okay.
you are selling here. But if it goes $1,000 up, that is your stop loss. Or you are buying here, so you have a $1,000 stop loss here. So based on your account size, you set what is the risk for each trade. Yeah.
Got it. I think that's the emotional problem of me chasing that I learned very recently. So it's last few days been very, at least couple weeks been consistent. So I thought I want to start a small personal futures account also.
Yeah, sure. Because at the same time, anyway,
Yeah.
if the setup is perfect, why not you make some money in personal also? Because
Personal.
sometimes,
That's why. So at least the all the indicators and the prop account monthly fees can be covered through the personal income. So that way it offsets that spend is what I was thinking. And once we
right,
make real money on prop accounts, that anyway is the bonus. That's what all the target is. So okay.
right.
So I
Yeah,
thought and I just reached home, so I'm going to switch into the annual plan today. And I know I want to do the 5 plan, and you said between the stocks and options, I mean, obviously, level manager is one thing. MTF level manager for stock and level manager for futures. And I use the T5, T55. I mean, T55, I don't know how much I can rely on these days. T5 for sure.
right. T5 and price pulse.
Price pulse, yes. So, and you said with annual plan, you would add one indicator. So, what should I pick as that bonus indicator? I would probably look for your guidance on that one.
Yeah, one is futures stock scan.
Yeah.
Then futures level or stocks level manager, T5 price pulse. And then, yeah, if you need one more, then the T55 is mainly useful for earnings.
No, the MTF anyway is one thing I wanted to add.
Right. So that is
Because that has been really good.
SPX also will help you. SPX daily income trade. That will help you if you are busy. You can just, if it says bear call spread, you can go a little
Okay.
bit above and you can do the bear calls for the day. If it says bull put spread, you go a little bit below, do the bull put spread.
Yeah. Got it. Okay. And I sent you my machine ID when I switched my machine for the algo. I know today is not that session, but I was trying to probably at some point want to have a small 30-minute or 15-minute session on how we can use that. So especially I now go to work for a couple days a week. So during those days, I can enable the algo to take 1 or 2 trades for the trade during the daytime.
Right. So it is the same thing, right? Basically, you watch for the direction of the channel. If the channel is in a downtrend, you can put only sell only on the ticker. That means only whenever you receive a sell signal, it will take the trades. If it gets a buy, it will not take the trades. So if ES and NQ are bearish, then we'll enable, right? It is better you enable when it is close to the top of the channel. You enable sell only option. If some ticker is bullish,
Yeah.
you
No. I mean, I remember I missed that. I tried configuring it using the let's see, video that I was looking at, but I was saying like how to configure the Ninja Algo bot so
yeah,
that
yeah, maybe
I
today
can, yeah.
today evening in the setup session
Okay.
we'll show.
Huh?
Yeah,
Okay. Thank you, sir.
sure.
Yeah. And today evening, what time will be that setup for everybody just to go over their portfolio and all that?
The setup session.
Yeah, I
Means
think you said we will review everybody's once we fill the Google form, the setup session, and in case people wanted to ask any questions. Yes.
no, that will be at 6 p.m. 6 p.m. Central.
Okay. Thank you, sir.
Yeah, hi Atul, do you have any question?
Yeah, Kishore. So I have one question. So if I look at the means plus 31, minus 31, and means every condition is right, and if I go into a trade, and after I go into a trade, that plus 31 changed to 29 or 17 or 1. So what should I do? I should just exit out of that trade or just look for it to change?
Generally, for example, let us say it is plus 31
Yes.
and you got a buy at the bottom.
Yes.
Then even though there might be some pullback, you can still hold it. Right? If it is a bullish ticker, you got a buy at the bottom.
Mhm.
Even though it changes to 29 or 25 or something, we can hold it because it's a overall bullish trend and you are not buying somewhere at the top. Because if it is 31, if you are buying at the top, it's risky. But if it is a bullish ticker, you are buying at a low price. That
And
means there is a high
Mhm.
possibility for it to bounce back.
Yeah. So can it happen, the breakout happen, because if it is coming down, it can do a breakout also and go more down.
Right. That's why right. For example, you are buying here, right? Your stop loss is here. You go,
Okay.
you see, right, where is the lowest point in last 4 5 candles. You just
Okay.
enable stop. So in case if it breaks down, then you are taking a loss. But that happens only 1 out of 10 times.
Okay.
Other 9 times you will make profit. So yeah, that's why if you are selling here, it is a bearish ticker, your T5 is at the top, your score is around minus 31 or something. Then you got a sell signal. You go little bit above the resistance, you put your stop loss, and then you can take a shot.
Okay. Okay. Got it. And I think one mistake that I was doing, I'm not putting stop loss. I was just watching it and taking on the fly decision. So what do you
Yeah,
suggest for a one contract? How much stop loss I should put? 200, 500?
if it is a 150K account, I suggest 500 to 600 is a good stop loss.
Okay. For one contract.
Yeah, and sometimes the candles will be so big, so better always you put immediately once you do a transaction, you go ahead and then you add a stop loss because yeah, sometimes it will be so fast you cannot react immediately, right? Suddenly it will. So better if you put it, then even though if it goes up, it will hit a small stop loss and then you can cover it in the next 1 or 2 trades.
Okay. Okay. So basically, if I'm doing two contracts at the same time, I should put 1,000 as a
Right.
stop loss.
Right.
One more question in the same line the guy was asking before. At a time, like if I'm from my personal account, so if I'm into a trade, okay, at one time, how much percentage of that account money I should put at risk at one time? What's your suggestion on that? So suppose I have a 100K account and I am placing five order. So how much percentage of risk I should take for that
So
100
if you have 50,000 account, I suggest 2,500 for every trade.
It's basically 10%.
No, 5%.
5%, sorry. Yeah, okay.
Yeah, maximum 5%, right? 4 to 5% is a good one. So if you're taking a bear call spread, right? Let us say tomorrow you took bull put spreads. You are at a strong support, and let us assume that it is bullish. So if you are collecting $200, that means 300 is the risk for each contract. So you can buy around 8 contracts. If you are only collecting $100, then 400 is the risk. So you buy 6 contracts.
Okay. Okay.
Like it. So yeah, see what is the or you are buying a naked call. You are spending $10 or $12. Then you buy some 12 means 20 contracts or 2 contracts, 2 SPX calls. Like that. So yeah, your risk, if your risk is same across all the trades, if we win 8 or 9 out of 10, even if you win 7 out of 10, will be profitable. But in one trade, you are putting a lot of money. In one trade, you are putting small money. Suddenly, one trade where you are investing a lot, if that loses, all the other 9 you make profit, still you may be at loss at the end of the day. So that's why I'll always divide that into 25 parts, whatever is your capital. Then use one part for every trade.
One thing also I have noticed, like whenever I take that SPX spread, means bull call or means bull put and bear call, means I wait till end of the day and then end up losing the money. So is there a way, means is there a percentage I should target that if I reach a 50% or 40% of profit, I just should exit and not wait till end of the day?
Yeah, or you can always trim some contracts. So, for example, it made a 40% profit. Let us say you took some 5 contracts. So you take profit on 3 or 4. So that one is like a free runner. So on that one, you can wait until expiry. So the minimum you got your capital and profits back. So that one is like a free runner. So you can leave it and you can let it expire. And also generally it is better, right? If it is at the bottom of the channel, we do bull puts. If you are
Yes.
close to the top of the channel, we do the bear calls.
Yeah, great ones, yeah. Yeah, and that I understand this thing, but the new thing that I have noticed recently, you're doing iron butterfly. That thing I didn't understand. What is that?
Right, with the bull puts and bear calls, you collect less premiums. You are risking 500 to make 150.
Yes.
Right. For example, here you are doing a bear call. Let us say we are taking 150, but your risk is 500. If suddenly goes up, you have
Yes.
350 risk to make $150.
Yes.
So here, instead of what you can do is instead of going up and doing a 20 delta bear call, you are selling a call, selling a put at this price, and you are collecting higher premiums. So instead of collecting 120, $130, you will collect nearly $450 premium.
Okay, if I do it at the same point, if I sell and buy put at that point, that's what you're saying, right?
Right.
Okay.
So either you can do iron condor, you can do a short iron condor. Instead of just doing a bear call, if you see that there is a support here or support here, you are selling calls, buying puts, and if price stays in between, you make money. Or
Yeah.
you can also just to sell a call, sell a put here, and then as a hedge, we are also buying a call and buying a put.
Okay.
So if yeah, so here you collect nearly $450. Your risk is 50, but you are collecting 450. So if it stays in the range, you can keep all the 450. So that is iron fly, where for the bear calls and bull puts, you are going up and taking some less premium for a higher risk. Whereas for iron fly, you collect the premium of the current price by selling a put, selling a call. And then if it stays in the range, you make more profit for a smaller risk.
Okay. So normally in such case, how much percent is the risk? 50% is the risk, right? If I'm getting 450, so I'm risking
Only
six
$50 is the risk.
$50 the risk. Okay.
Right, because one of the legs you will make full profit, one of the legs even if you make loss, only 50 is the risk.
Okay. Okay.
Yeah.
Got it. Okay.
Yeah, AB, do you have any questions?
Hey, Kishore, hello. Yeah,
Yeah,
I
please.
have a question. So couple of things, right? Couple of questions I have, right? Just a second. So I was seeing your screen, right? So you were showing some of the India stock as well. So do you have, like, these indicators will work on the India stock as well?
Right, yeah, you can use indicators on anything.
Right. Do you have any India stock, like the watch list or something like that, if you can share?
Yeah, I'll post it in the premium channel.
Okay. Yeah, that'll be great. And then the indicators also will work, right? I mean, like price pulse, I know it will work, but scan and those things will also work, right? The stock scan on the.
Yeah, yes.
Okay, all right. Okay, so another thing is that on the futures, right? We can do the options on the futures as well. I think you have explained in one of your videos, right? So, what is the recommendation? Do we start do the bull put or bear call? Let's say on the commodities, right? Let's say gold or silver. We
Mhm.
can do that as well. Or what is your recommendation there?
So that's what right I explained today. If
Let's say morning time I'm busy, but I have
for
evening
for
time.
example, yes, let us say yes, trend is bearish, but you are at a strong support. Let us say you are at the bottom of the channel. Then you can do bull put spreads. Right? You can go below and you can sell the puts and buy the puts and collect the premium. So if ES stays above that price by morning, you'll make some nice profits.
So this you're talking at night, right?
Right, night time. Right. Let us say before you sleep, you see that ES is at a strong support. T5 came all the way to the bottom. If you
Right.
go below and do, because there won't be major news or something, there won't be a huge, right? Either it will be choppy or it can go up. So by the morning, you can collect some money, right? Even
Right.
before US market opens, you can make some nice 20-30% profits with the bull puts you take. Or let us say you are somewhere at the top. You can confidently take bear call spreads or debit, right? Bear call spreads is more better, but you can confidently take more contracts because overall trend is also bearish. It is in a downtrend, and you are somewhere at the top. If T5 is also at the top, you can confidently take bear call spreads or even debit puts. Like that, yeah.
Okay.
If you are going against the trend, bull put spreads. If you are going along with the trend, you can do the debit spreads.
Okay. So you're saying at night there'll be not much volatility, right? Because the market is not that moving.
Right. Yeah, the
And so,
theta decay will help you to make money, even
so
if
is
it
it
stays.
recommended? Sorry, yeah, is it recommended? Like, I'm just trying to give a preference, right? Let's say commodities versus indices, right? Like, because you see gold or silver also going. If it start the downtrend, it will remain in the downtrend. It will start. So, do we can we incline towards commodities or indices? Because indices move really fast. So, I'm just thinking that way.
Yeah, but generally your indices will be generally right, even though they may go up again, they come down by morning. So they will be more choppy in the evening time, whereas your commodities move more in the Asian market, GC, silver, like that. So again, if you see a perfect right along with the confluence, if it is with a proper trend, right? Let us say if your GC is bearish, The GC channel is in the downtrend. It is bearish. You find somewhere GC here before you sleep. Then you can do the bear call spreads confidently. But if GC is somewhere at the bottom and the trend is bearish, because there can be big moves with gold overnight. That's where you have little more risk with GC silver overnight compared to indices, because indices won't move much. RTY, and when they don't move much, if you are doing bull puts or bear calls, that is an advantage, because if they stay choppy also because of the theta decay, you will make money.
Okay. Okay. So basically, we just take that maybe 5 points above that if we're doing bear call,
Right.
and then
Yeah.
okay. Okay. Got it. And then for these, like only 5 minutes is fine, or like we should see the 1 hour as well for doing this
Again,
bear
right?
call.
You can use the scores. If scores are -31, you can do bear call spreads on them. Scores are +31, you can do. Then you are checking all time frames. You know, RTY is bearish, so you can, if it is somewhere here, you can confidently do the bear call spreads. But it is now at the support. If it is at resistance, you can do bear calls. Yeah, 5 minutes along with T5 and the score confluence is good enough.
Okay, the T5 and the price pulse is good, right?
Right.
Mhm. And so another thing, like regarding the price pulse and this thing, right? We see some of the order blocks here, and then if we activate the price pulse, we see another order block. So what is the difference between the future level indicator order block and
This
then
is
the price
more
pulse action?
static. Static price pulse is more dynamic. It pulls the order blocks immediately. If there are any new order blocks or anything, it immediately pulls it. Here it
Okay.
is static because, yeah, if you include too much of functionality, that will slow down. So that's why here we have more static order blocks.
Static means it has been there for a while, or like it's not the real time.
Right. So it will give a high level picture, but yeah, even though you have an order block, it may drop after some time.
Okay, got it.
Yeah.
Okay, Kishore, yeah, thanks.
Yes, Santosh, do you have any other question?
Hello.
Yes, Santosh, please go ahead.
One question I had was, do we no longer need futures level manager given I see you have those bands and etc. right in the MTF scan?
No, again, futures level manager is for scalping, right? For example, so here if you want to hold the trade for longer time, then this MTF stock scan or future scan will help you. But if you want to take trades at the bottom of the band, take profits at the top of the band, again, you want to take multiple opportunities, then your future scan will be helpful, or futures level manager, stocks level manager, they will be helpful. So here you have only buy signal, one sell, right? On the entire day,
You were
you
saying
have.
you made some changes to the MTF scan, right? So that is the reason I felt like it's integrated into both. That's what I felt like. Is that understanding correct or no?
Right, that is right. But what I'm telling is, if you are more of a day trader, then the
Mhm.
future scan and stock scan are good. So here you got one sell signal, you got one buy signal,
I
and you
see.
got you got one. Total, you have only three signals the entire day.
I see. Not
But
like
if
minute granularity.
right,
Got it. Okay. Yeah. Cool.
so if you
Thank you.
want to take multiple opportunities, there, right here, you will get a buy. Again, it went to the top, you get a sell. Again, it dropped, you get a buy. Again, it goes to the top, you get a sell. So you have more buy and sell opportunities with futures level. That is good for scalpers. This is good
Hmm.
for day traders.
Right. Okay. Yeah. Makes sense. Thank you.
Is that the band, Kishore sir, you're talking about? That it's green and red band. Maybe I joined late or something. I missed it.
Yeah, this is like a channel. Yeah, this is like a band. So when it goes to the bottom of the band, if you see buy, it's a good. If it goes close to the top, when you see a sell, that's a good.
And this is part of your scan, not the future level manager or software manager.
Right now, I added this one to this scan itself. So yeah, within the scan itself, you can see the bands and.
Okay, so we don't have to look at the future level manager scan. That sorry, the band.
Right, as I mentioned, futures level manager is good for scalpers. This one, MTF future scan, stock scan is good for day traders. If you want to just take limited trades, then these stock scan, future scan will help you.
Oh, I see. Okay, got it.
So here you don't have all the levels, magnetic level, all those things, no band. So this is more for if you want to just take one trade and hold it for longer duration. Then yeah, this will help you. Stock scan and future scan.
Okay, got it.
Yeah, Manipal, do you have any other questions? Yeah, we can't hear you, Manipal, if you're talking.
Yeah, sorry, can you hear me now?
Yeah, please go
Yeah,
ahead.
sure. Yeah, I have one question. If I want to trade only SPX, what are the best indicators?
This one, right? The stock scan, E5 and SPX credit spread daily income. These are the three best ones. You can just do whenever you get sell at the top, you can do bear calls. Whenever you get buy at the bottom of the channel, you can do bull puts.
Okay, RC, MTF, stock scan, daily income, and the third one?
The T5, RCT5.
RCT5. Okay.
Mhm.
Okay, got it. Yeah. And these three we have in a one plan, three indicators.
That is right, yeah.
And 350, that is per month, right?
Right, yeah.
Okay, yeah, thank you. That's it.
Yeah, VS, do you have any other question? Yeah. Yeah, if not, yeah, I hope you understood, right? When we take naked calls, when we take naked puts, debit calls, debit spreads, iron condor, or bull puts, bear calls, iron fly, right? When you take some live trades tomorrow, day after, you will understand much better. But yeah, for now, minimum understand until iron condors, then iron fly, yeah, you will understand much better in the live sessions. But yeah, if we just follow the strategies at the same time, we can make money with SPX, with ES and Q. Right? All we are looking is it bullish or bearish? Once it is bearish, the lowest risk is wait for the sell signals close to the top or close to a sell order block, close to a resistance. If it is bullish, wait for buy signals close to the bottom or close to a buy order block. If you get buy, you can do bull puts, you can do naked calls, you can do debit spreads, you can go ES long. Same thing with any, right? Whatever that is, futures or currencies or cryptos, whatever it is, the strategy is same. Bullish ticker, buy at the bottom, bearish ticker, sell at the top. And if you have more confidence, you can go with more confidence. So you have resistance, you have sellers, T5 went to the top, trend is bearish. So then you can confidently take more bearish calls or more naked calls or debit spreads like that. So yeah, that's it, everyone. So we'll connect today evening at 6 p.m. for the setup session. Bye, everyone. Have a nice rest of the day.